Evidentiary hearing in Public Service Commission docket 1957-2, application of Dominion Energy Utah to increase distribution rates and charges and make tariff modifications. This is the Phase 1 hearing on revenue requirement. We had completed cross-examination of witness Mr. Jordan Stevenson. We had indicated that we would give parties one more opportunity if they want any additional cross-examination before we move to any redirect. So I will start with that, ask any parties to indicate to me if they want to do any more cross before we move to redirect. Did you have a comment?
I do. I've spoken to most of council present about hearing exhibit 7 that drew so much discussion yesterday. The company has prepared a revised exhibit that removes all of the numbers that other parties found objectionable. And so I don't know if it's appropriate to offer that now before cross continues, or if you'd like me to wait for redirect to do that.
Probably makes sense to go ahead and do that now.
I will do it. Thank you. May I approach?
Yes. Thank you.
May I quickly lay the foundation for this document?
Yes.
Mr. Stevenson, you've just been handed what is marked as DEU Hearing Exhibit 7R. Can you describe what that is?
Yes, this exhibit shows the original proposal the company filed in this case, along with adjustments that have been proposed by various parties participating in this case. And from rows I'll just summarize. DEU's position as it relates to each of these adjustments is shown. The amount shown is what DEU currently calculates its acceptable adjustment to be. And where you see zeros next to any particular adjustment, DEU does not agree with that adjustment.
Thank you. The company would move for the admission of DEU Hearing Exhibit 7R.
Okay, if any party objects to this motion, please indicate to me. I'm not seeing any objection in the room, so the motion is granted.
Thank you. And Mr. Stevenson is available for further cross.
Okay, does any party want to do further cross-examination before we go back to redirect? I'll just look for any indication from anyone. I'm not seeing any, so we'll go to redirect.
Thank you. Mr. Stevenson, yesterday when you were speaking with Mr. Snar, you may recall that he discussed the company's capital budget. Do you recall that?
Yes.
Can you describe for the commission the company's process in developing that capital budget and how it may evolve over time?
Yes, and specifically to this case, I'll talk about how the 2020 capital budget was prepared. So the budget we filed in July of 2020 was based on the capital budget that actually had been prepared in the fall of 2018. And it was based on our best knowledge of what projects would occur in 2020. And as the process goes, as we get closer to the actual year of construction, we gain new insights about the conditions that will be in place in 2020, and sometimes reality causes a change in planning. For example, it could be that cities do not allow us to come in and do construction at the same time that we would like to come in, and there may be other considerations. And then even in the period of construction, within 2020 itself, there can be changes that occur related to unanticipated project scope changes. For example, if you're installing a feeder line, and this has been something I think we've seen in the feeder line tracker budgeting process that we report on thoroughly in our feeder line tracker program, there's costs that we don't necessarily know a year and a half in advance. For example, if we start digging a trench and find contamination in the soil and have to incur costs to clean it up, and dismantling costs go up significantly, Those items all are very difficult to project when you're a year and a half out. That said, as we get closer, each individual project is subject to variance related to those things. But what we've seen and what we have a history of seeing each year is that each of these individual projects may vary, but when you sum them all up together, those variants tend to offset each other. And that's the reason why our total capital budget doesn't vary significantly normally, and on average has been within 1% over the last 5 years. We've looked at 2019, for example, and we're close to the end of the year. And now knowing what the actual capital spend has been through 2019, we anticipate we'll end the year slightly above the $233 million total, although particular projects may have shifted and there's variance within categories. The total budget doesn't vary significantly. And with that knowledge and going into 2020, we're very comfortable that the $277 million amount is appropriate.
Mr. Stevenson, Mr. Snar also asked you about professional services, a proposed adjustment that has sometimes been, in this case, referred to as LNG costs. And I want to follow up on that a little bit. With regard to professional services, I believe you testified that they are services like engineering analysis and legal work. Is that right?
That's correct.
And doesn't the capital budget for 2020 include large projects like the Southern System expansion, which I think is a $20 million item, and the Kern Gate Station, which is a $14 million item? Is that correct?
That's correct.
Would you expect projects like that to need professional services like engineering analysis and legal work?
Yes.
Mr. Stevenson, I also want to talk to you about the transponder and dismantling costs. Do you recall discussing that with Mr. Snar yesterday?
Yes.
And do you recall offering to provide or write a diagram or a chart that could help explain it?
Yes.
Have you prepared such a chart?
I have.
May I approach?
Yes.
Mr. Stevenson, can you please, I've provided you with a document that's labeled DEU Hearing Exhibit 8. Can you describe what that is?
Yes, this is a summary of the transponder cost in this case. Column A shows the original impact of transponders that I had included in the 2020 test period. Column B shows adjustments or the impact that the office or Ms. Ramus has included in her testimonies. And column C shows an update based on analysis I've done after reviewing Ms. Ramus's testimony and consulting with our project manager over the transponder program as well as our accounting group. And so just to walk through what these rows are, row 1 shows the rate base items that we're talking about. And as has been discussed, dismantling costs incurred during any specific period have a rate base impact in that they reduce the accumulated depreciation balance. And so that increases rate base. In my test period, I had used a system total factor for dismantling that I calculated using a 3-year average of total dismantling costs historically over total retirement costs. And I applied that to all retirements, including transponder retirements. And as Ms. Ramos pointed out in her testimony, historically the transponders had not incurred or shown on the books dismantling costs. And so she recognized an adjustment down to reflect that there will not be dismantling costs in the test period in 2020 and in 2019. And so her adjustment shown in column D, and I actually accept the adjustment as a $3.6 million downward adjustment to rate base related to dismantling and transponders. I also reviewed, as it relates to transponders, the system total factor that we included in our original model and in our rebuttal model to estimate how much investment would be left in construction work in process. And just to explain how that works, we have a capital budget for the year, and oftentimes projects are not completed by the end of the year. So although we may spend, in this case, $11 million on transponders, a lot of our projects are not in service, and if it's not yet complete, we do not include that in rate base, even though we've had capital spend on that. And so to estimate how much would be left in the construction work in process and not be included in rate base, I used a system-wide factor based on 5 years of history of total capital spend versus total amount left in the 107 account, which is construction work in process. And that 5-year history showed a 29.15% average amount of capital spend that stays in CWIP, so it wouldn't be close to rate base. Looking specifically at transponders and talking with our accounting group, the transponders themselves actually don't stay in construction work in process because it's not an ongoing construction project. It's a very rapid change out when a technician removes a transponder and places a new transponder on a meter. So we wouldn't expect to have any construction work in process balance. And so my position is if we're going to depart from using the average system-wide total factors and account for transponders individually and specifically, we should update all three of those factors: dismantling, proceeds, and construction work in process. So my row 2 of this exhibit, hearing exhibit 8, reflects the update in that construction work in process factor, and it actually increases the rate base amount that will be closed to investment by $2.3 million. When you add those items together, we have a net reduction of $1.3 million in rate base. And then I also have a reduction related to depreciation expense, and these adjustments are shown in column D. And this is what I would propose being a reasonable amount to adjust our test period by.
The company would move for the admission of DEU hearing exhibit 8.
If anyone objects to that motion, please indicate to me.
I would object without the opportunity to further examine Mr. Stevenson on this particular document.
Do you have any objection to holding this motion
No,
until after
I would be happy to hold the
recross?
motion.
Okay.
Sure.
Any other? Okay.
I do, please. Mr. Stevenson, I have one more topic to discuss with you. There was a fair amount of discussion yesterday with Mr. Russell about the pension, proposed pension adjustment. Do you recall that discussion?
Yes.
And do you recall being provided with what are marked as OCS cross exhibits F1 and F2 that are testimony from the merger proceeding before this commission? Do you recall that?
Yes.
And you were asked in particular what the company meant when it said there would be a benefit to customers in perpetuity. Can you speak to what you understand that to be?
So I believe Mr. Felsenthal was asked that question. I don't know that that came up to me specifically yesterday, but I did hear the question, and I'm familiar with the cross exhibit that you're referring to. And so my understanding is what Mr. Wolfarth was referring to in his testimony in that docket is that by contributing $75 million to the pension fund, we have a larger base that will generate a return in the pension fund. And so how the pension accounting works is you have service costs and interest costs. Then you also have a return on plan assets that reduces those costs. And so that return on plan assets is basically applying a market return that those assets are performing by a base of assets that exist in the plan. And the 75 million was derived simply by applying the expected return on those plan assets, which I believe at the time was 7%, by the $75 million amount to derive a benefit. And in terms of whether or not that will ever change or go away, the 75 million, after it's contributed into the plan, will continue to generate a credit going forward into perpetuity. And although the pension expense itself may change, the amount may change, the amount of assets that were contributed will never change. That will continue to create a credit that reduces the pension expense. So whatever level it would have been going forward will have been reduced because there is now a higher amount of assets that are earning a return in the pension fund.
Mr. Russell also asked you about the pension credit amount related to the 75 million contribution, and you had identified a $3 million pension credit. Assuming, Mr. Stevenson, that the asset was also included, what would the asset balance be related to that $75 million contribution?
So we had referred to an exhibit, and I'll just open that back up again. It was included in Ms. Ramos's direct testimony, and it was Exhibit 2.16D, OCS 2.16D, and that is a data request that had been asked by the office. And we had identified that there's a $3 million credit amount.
If I can interrupt you, can you point us to the page within that rather voluminous exhibit
Yes.
for the commission's benefit?
Yes, absolutely. It's page 22. So we had identified in that exhibit the $3 million amount shown in the bottom right corner of that table, and that relates to the return on the $75 million contribution that was placed into the fund in 2016. If you were to identify, rather than identifying a specific credit amount, you wanted to identify a specific asset amount today. We know that the total asset balance we included in the test period was 112 million. You'll notice that part of that is related to the Dominion Energy affiliates, and part of it is specific to Questar Gas or to Dominion Energy Utah. Here the credit was 65% of the total gets allocated to Dominion Energy Utah, and it would have been the same for the asset. So the asset would be 65% of the $75 million amount that would be on Dominion Energy Utah's balance sheet related to that contribution. And I did want to expound a little on your previous question, if I may, related to Mr. Wolfarth's testimony. As I reviewed that and understanding the conditions that were in place at that time, my understanding is that Mr. Wolfarth was explaining that the pension expense would be reduced by the $3 million credit into perpetuity, and I believe that remains true. That will continue to be the case. What I don't believe is true, however, is that he was claiming that if the pension expense is zero in the future, that then other operating and maintenance expenses would be reduced as a result of a pension contribution. I believe that it remains true that any potential pension expense, whether it's negative or positive, continues to be reduced by $3 million because of that contribution, and that hasn't changed. But I believe it goes beyond the scope of his discussion to then say, if we have no pension expense today, that we will now reduce other expenses in a test period. I don't believe that was contemplated at the time, and I don't believe that was the meaning of what Mr. Wolfarth was saying. So,
I have no additional questions for Mr. Stevenson.
Okay, thank you. Mr. Jetter, any recross?
Just a couple brief questions about what you just discussed in the pension fund. Just so I'm maybe clear for the record and clear for my own understanding here. If shareholders of the company were to put $75 million into the pension fund with the expectation of earning a return on that, the weighted average cost of capital sought by the company is around 7.3%, just for ballpark. And if the return on that investment, if we considered it an investment by shareholders rather than a funding at shareholder expense, and it was earning around a 7% return, that would effectively be meaningless to customers. Is that right?
So I'd have to do the math, but I believe the expected return on that contribution at the time was 7%. Right now, it's 8.75%. So I guess if you compare that to the return on rate base, I believe Mr. Felsenthal may have done that comparison in his testimony, and I think he showed that the return included in rate base was actually slightly less than the return on plan assets that reduces the pension expense, so that it did have a slight benefit to customers to do that.
Okay, but that wouldn't total around $3 million, would it?
No, that's correct.
Okay.
And let me just reiterate as well, our position, although Mr. Felsenthal presented evidence as to why it may be reasonable and make sense to include the pension asset and rate base, my proposal is not to include the pension asset and earn a rate of return on that. Our proposal is to strip it out.
Thank you. I just wanted to make sure that was clear, that if that were put into rate base, the return would effectively offset the benefit to customers. And I have no further questions. Thank you.
Mr. Snar?
I'd like to request just about a 5-minute recess in place. I need to confer with my clients on just a couple of matters before I proceed.
Okay, why don't we recess until 9:30?
Okay, thank you.
We'll be back on the record. Mr. Snar.
Thank you. Mr. Stevenson, you've been asked some questions just this morning about the pension issues, and you've described the $112 million that was contributed into that pension fund. Is that right?
Yes.
And isn't it true that you've suggested that that $112 million ought to be considered as part of rate base in order that a return could be earned on that?
My proposal has been that these items should be treated symmetrically. So if a pension credit is included in the test period, then the associated pension asset should also be included. But we could also treat them symmetrically by removing all items. And so my proposal is actually to treat them symmetrically by removing them and not including the pension asset or credit in the test period.
Isn't it true that a portion of that $112 million that we were talking about does not pertain to the utility operations of Dominion Energy Utah?
No.
I'd like
That's
to
not
refer
true.
you to OCS data request response 3.02 was provided to the office. Do you have access to that?
Yes.
And in looking at that, do you see the figure of 65.62% anywhere on that page?
I do.
Could you explain what that information is that you have previously provided to us?
So that's the amount of the total pension fund, which is held at the corporate level, formerly Questar Corp. And it's allocated down to all of the Western affiliates here. So we have Questar Pipeline, Wexpro, and Questar Gas Company, now Dominion Energy Utah. At the time this funding contribution was made, 65% of that total pie came to Dominion Energy Utah, the utility. The $112 million amount is after the 65% has already been allocated. So that $112 million exists on Questar Gas books as a Dominion Energy Utah portion of the pension. The $112 million is not a total corporate asset. It's already allocated.
Okay, thank you. Now, turning to the other issues that you've addressed here, the issues related to the transponders. In connection with the testimony in connection with the exhibit that's been identified as hearing Exhibit 8, you have certain information you've provided there and attributed to the office's witness, Ms. Ramos. Is that correct?
That is.
And what was the source of that information?
Sure. So referring to column D on the adjustment, the $3.6 million adjustment comes from the direct testimony of Ms. Ramos. I apologize. Is it Ramos or Ramos? I don't want to keep saying it wrong if I am.
I'm not sure I said it right.
Ramos. Okay, thank you. Ms. Ramos, her exhibit 2.6D showed an adjustment of $3.6 million
And
to rate
that was
base.
in her direct testimony filed on October 17th of 2019, correct?
I believe so, yes.
And in your rebuttal testimony, your rebuttal testimony is filed on November 14th of this year, is that right?
Right.
And in connection with that, you provided an Exhibit 3.2 in connection with your rebuttal testimony, is that right?
Yes.
And I'd like to
3.2R.
direct your attention to line 9 of Exhibit 3.2 of your rebuttal testimony. Do you have that there?
You said 3.9?
3.2.
Oh, I'm
excuse
sorry.
me.
3.2. Yes.
And directing your attention to line 9, that you indicate there that the forecasted spend for 2020 is $4 million. Is that correct?
That is correct.
And that's inconsistent with the exhibit you've presented today, isn't that correct? More specifically, directing your attention to footnote 1 of the exhibits you've presented today, and about the 4th line down, you represent that the total 2020 spend is $5 million, isn't that right?
That is correct.
And so there's an inconsistency there. Can we rely upon the rebuttal testimony we previously submitted on November 14th?
Yes, my apologies. I do believe that the 5 million is a previous number. It should be updated to 4 million.
Okay, thank you. I'd also like to direct your attention to line 12 of your Exhibit 3.2R, part of your rebuttal testimony. Do you see that?
Yes.
And there's a figure there, $3,705,545. Is that correct?
That's correct.
What does that particular figure represent as you've presented that in Exhibit 3.2?
That's the amount of removal cost that was incurred related to transponders from the period of 2016 through 2018.
So from the period of 2016 to 2018, that's the number, and where was that accounted for?
That was originally included in the construction work in process account and moved over into the 101 account.
And that's plant in service, is that right?
That's right.
And where is that amount today?
The amount remains in the 101, and it will be adjusted along with the dismantling. So the update to dismantling costs will include a movement from the 101 account to the 108 account, the accumulated depreciation. So the net impact to rate base of that adjustment is 0. It's a reassociation from positive 101 balance to the 108 balance.
And on the exhibit number 8 that you've presented today, that we're talking about today, that number or that adjustment is not shown or reflected anywhere on that page. Is that right?
I'm sorry, which number did you refer to?
The $3,705,545.
Sorry, I'm just reconciling here. Right, that's not part of the calculation included. I believe if you add the $3,705,000 amount shown on line 12. Let's see. With the removal costs shown on line 8, you arrive at a $4.7 million amount roughly, which is represented in footnote 2 of hearing exhibit 8, which shows a decrease of $4.71 million. So the 4.71 million on the footnote is derived from the 3.7 on row 12 plus the $1 million amount in removal costs on row 8.
That's in your footnote 2, second to the last line, is that right?
Yes, that's correct.
That concludes my recross based upon the new information. The office still opposes this exhibit for admission.
Okay, why don't we go, why don't we go back to the motion to admit this exhibit? Do you have anything you want to add to that motion?
I guess I would like clarification on the basis for the objection.
Do you want to add anything?
Sure. The basis for the objection is it doesn't show the complete picture as we've demonstrated in some cross-examination here. And also it presents late filed information, which is difficult for us to cope with and is not part of what these administrative proceedings are all about. They had the information from Ms. Ramos commencing October 12, had full opportunity to develop this kind of an exhibit and present it as part of their rebuttal testimony so that we could look at it, understand it, and cross-examine with a little more preparation than merely responding a few minutes after it's presented here on December 18th.
Does any other party want to weigh in on this motion? I'm looking around the room, I'm not seeing any other indication. Do you want to make any final?
I do. While I appreciate that this is information that we discussed with Mr. Snar and his client, or provided to them yesterday, it was provided in response to some cross-examination from Mr. Snar himself. And if we look back at the record, you will see that Mr. Stevenson often offered to use a white pad to provide exactly this information. And Mr. Snar sort of invited it. So I think it's completely appropriate as a redirect question. It's completely appropriate as a redirect exhibit.
Mr. Snar, do you disagree that this is within the scope of your cross-examination?
I don't have an objection that's beyond the scope of cross. It's just late filed information. Excuse me. It's late filed information coming to us. It's difficult for us to respond on the fly on complicated accounting issues which are reflected here, some of which has been presented with misinformation, and some of which, well, all of which could have been presented as a part of the rebuttal testimony that was previously provided. Those are the issues that we have and the basis for our position at this time.
Okay. I think the way I'm going to rule on the motion, I don't see this as any different than if the witness had verbally presented this information in redirect. I think we're going to treat this as such with your objections to it noted. However, I think considering that it is within the scope of the cross-examination, I don't see a basis to deny the motion. So we're going to grant the motion to grant the motion to admit it as a redirect exhibit related to his redirect testimony. And as we consider it, we understand the objections to the numbers and the objections to the calculations.
We would ask some latitude in how we react to this as we put our own witness on the stand, as we might want to address this more directly and haven't had a chance prior to this time to do so.
I anticipate that we would allow some flexibility when we get to there. Thank you. Major Kirk, do you have any recross for Mr. Stevenson?
No question, sir.
Okay. Mr. Meekum?
None, thank you.
Mr. Russell? Okay. Do you have anything else based on the recross that we had from the division of the office?
I do not. Thank you.
Okay. Commissioner Clark, do you have any questions for Mr. Stevenson?
I do. I'd like to just have you clarify some information regarding the outside contractor costs that are that you referred to in your redirect. I think you referred to a couple of projects in 2020. Would you just repeat what those were for me again and their approximate capital costs?
Sure. So one is a gate station, a new gate station to serve the northern region. It's off of Kern River Pipeline, a $15 million capital project. and the other was the southern system expansion to construct a loop of additional pipeline to serve southern Utah, and that was $20 million in 2020.
And the year that the contractor-related costs that are being suggested for removal was 2018, is that correct?
Right, that's the base period they were incurred in.
Right, so in that base year of capital expenditures, what's the largest project outside of the LNG facility that would be present if we had a list in front of us?
In 2018,
Do you by chance have that in your record?
off the top of my
exhibits?
head, I think it would be in the record. I don't know that I have a copy of it. Off the top of my head, and I'd have to check, but I believe that the feeder line tracker program probably contains one of the largest projects in feeder line 21, which is tens of millions of dollars in 2018, but I'd have to pull the individual projects to verify if that were the largest and what the actual amount was.
And the nature of these outside contractor costs, do they apply generally or maybe even exclusively to services that pertain to seeking the approvals, the administrative approvals for constructing the project, or are there other types of costs involved?
So it's other types of costs. So I believe the reason why the 2018 costs became a question was that there was a docket on that particular issue that required some legal costs. However, the scope of those services includes preparing, for example, preparing a request for proposal on a scope of work, on hiring contractors, also doing engineering type analysis, and whether or not there's a special docket involved related to that or an approval needed. Those kinds of preparations and analyses would need to be conducted. So for example, with the gate station, it's large enough where we will need legal services to prepare a request for proposal for that particular project, as well as for the Southern System Expansion Project. And it'll be a similar scope of work to what we had to do in 2018.
Similar to the feeder line project?
Or similar to, I guess we've referred to it as the LNG project that the data request was based on.
And would those services be provided by DEU employees, or would they be outside services, or some mixture?
It's so the specific adjustments just for the external services, and the 2020 projects that we're discussing would include external services as well. So I believe the amount we're discussing, the 200-some-odd thousand amount, is just for the external service portion.
Do you have any sense of how much of that, of the amount that is being scrutinized relate to the services provided for preparation for and the conduct of the approval proceeding or the application proceeding before the commission?
No, I apologize. I don't have that breakdown. I couldn't tell you.
If I were to think that most of it pertained to the approval and application process, would I be wrong, or what's your judgment about that?
It's hard for me to say. I really wouldn't be able to weigh in on whether or not Most of it were, if it were a minority of the costs.
We're at least pretty sure that the projects you're thinking, or that you're proposing to complete in 2020 won't require that same kind of pre-approval process, or won't involve that process. Is that true?
Well, I mentioned yesterday, there are some projects that will have a pre-approval type project, a process associated with them that will be occurring over the course of 2020. One is related to an expansion to serve Eureka, and that was filed on December 1st. I think we anticipate that docket over a 6-month period, so it would be in 2020. Another is related to the Clean the Air legislative effort that the company is responding to, that would be filed on December 31st of this year is the plan, and that would extend into 2020 as well.
Okay, those are different than the gate station and the
Right, yeah, so it is a
expansion in
mix of,
Southern, yeah,
yeah.
okay. Thank you, those are all my questions.
You're welcome.
I just want to restate Commissioner Clark's first question, but with one additional limitation. Off the top of your head, could you identify any 2018 capital projects other than LNG that are not part of the infrastructure tracker? You know, for example, line replacements that weren't within the tracker budget or anything like that.
Yeah, I know we replaced quite a bit. I think it was up to 90 or so million, if I remember the rebuttal testimony of Mr. Mendenhall correctly. We could pull the specific amount. I couldn't tell you, I guess, the specific project name or how it was named by the project managers, but we did do $90 million of replacement outside the tracker. I'm trying to think if I can recall another specific project in 2018.
That answers my question.
Okay.
Thank you. Commissioner White?
I have no questions, thank you.
Thank you, Mr. Stevenson.
Thank you.
Anything further from Dominion?
Nothing further from the company. Thanks.
Okay. Based on our discussions of schedules yesterday, is there any objection if we move to Major Kirk and his witness next? Okay. Major Kirk, are you ready to present your witness?
Yes, sir. FEA calls Michael Gorman.
Good morning, Mr. Gorman. Do you swear to tell the truth? I do. Thank you.
Good morning, Mr. Gorman. Could you please state your name and provide your business address?
My name is Michael Foreman. My business address is 16690 Swinsley Ridge Road, Chesterfield, Missouri.
And I don't think our microphone is picking you up. Thank you.
Sir, would you briefly provide your position and background and your role in this case?
Yes. I am a managing principal at my firm at Brubaker & Associates. We are regulatory and economic consultants representing predominantly large institutional, industrial, and government agencies in regulatory proceedings around the country and in actually around North America. We also represent certain state commissions on part of their litigation staff. In this case, my testimony concerned developing a fair rate of return for the company. I made several adjustments to the company's proposed rate of return, which was based on a capital structure with a 55% common equity ratio and a return on common equity of 10.5%. I found that the company's proposed overall rate of return is excessive, principally for two reasons. First, I believe that the rate-making capital structure with the 55% common equity ratio is far more expensive than necessary in order to maintain their financial integrity, credit standing, and ability to attract capital under reasonable terms and prices. I believe it's important that the rate-making capital structure reflect an appropriate balance between the company and their customers to ensure that rates are just and reasonable in support of the utility's financial integrity and credit standing. A capital structure that I found that is more appropriate to meet those objectives at a lower cost to retail customers is the last authorized capital structure for Dominion Energy Utah and its predecessor company, which included a 52% common equity ratio and a 48% common equity ratio, 48% long-term debt ratio of capital. In assessing that capital structure, I reviewed credit metrics for this utility in the 2020 test year based on cost of service principles for this rate case. Those credit metrics indicate that a 52% common equity ratio with a 9% return on equity, which I'll talk about in a minute, produces credit metrics which are more than adequate to support the utility's existing bond rating, which is BBB plus from S&P and A3 now from Moody's. I also looked at rate-making capital structures for other electric and gas LDC companies around the country to get a sense of what regulatory commissions typically find to be reasonable and balanced capital structures for rate-making purposes. That assessment indicated that a rate-making capital structure right around 50 to 52%, as I proposed here, is a reasonable balanced capital structure and likely is reflective of what the market participants would expect a regulatory commission to find as a fair and balanced capital structure for rate-making purposes. I also looked at the indicated debt leverage metrics for various bond ratings for utility companies, and that assessment indicated that a 52% equity ratio and 48% debt ratio would support credit metrics that reasonably align with credit metrics and medians for industry debt ratios, which also support the utility's existing bond ratings. Adjusting the equity ratio from 55% to 52%, I believe will maintain the financial integrity of the utility, but do so at a much lower cost to the utility. I also encourage the Commission to consider the cost of capital as a discretionary cost that the utility management does have control over. The actual mix of debt and equity for the utility is made by explicit decisions on behalf of management. To the extent the capital structure mix results in unreasonable cost, then I believe it's appropriate to adjust those costs down to a reasonable level for rate-making purposes. That price signal then to management would encourage the company to modify its actual capital structure to conform to what the rate-setting authority believes is appropriate. I believe that's consistent with regulatory principles that price setting should provide signals to management just like they do in a competitive market, but also do so in a regulated market. Again, a 48% capital structure is a reasonable mix that is lower cost than what the company's proposing and will maintain their bond rating and is consistent with what's going on in the industry generally. The second issue I took with the utility's overall rate of return was their request to set the return on equity at 10.5%. I find that authorized return on equity or that level of return on equity to be unreasonable. I believe it's significantly in excess of what the current market cost of equity is for a utility with this utility's overall investment risk characteristics. In making that evaluation, I first conducted my own study of what the current market cost of equity is. I measured the current market cost of equity with using 3 versions of the discounted cash flow analysis, 2 versions of a risk premium analysis, and 2 versions of a capital asset pricing study. That analysis indicated that the current market cost of equity for this utility falls in the range of about 8.7 to 9%. I observed, because I do rate of return studies quite frequently and have for about the last 30 years, that those models are indicating a reduction in the authorized or the market cost of equity for utilities more recently. And based on that experience, I thought it was more appropriate to recommend a return on equity at the high end of my estimated range because of the change in market circumstances. And by that, I'm simply referring to uncertainty about the market, about where the economy is going forward, whether or not we're heading for another recession, or whether or not the market is overinflated. When the market conditions kind of signal that, the markets generally moves investments into lower risk, stable investments, which the utility is included within the category of, and that has the effect of increasing prices and lower cost for low risk, sectors in the marketplace, which includes the utility industry. I also looked at the return on equity studies offered by the Dominion Energy Utah's witness, Mr. Hevert. His recommended return on equity of 10.5%, I don't believe is supported by his own studies if they are corrected for more reasonable inputs. I found that his DCF analysis was overstated in some parts because of his use of value line growth rates, which were far too high to be reasonable estimates of long-term sustainable growth rates. His use of consensus analyst growth rates produced more reasonable outlooks for future growth. And by adjusting his DCF analysis to provide predominant reliance on consensus growth rates showed that the current market cost of equity under his study would have been less than 9%. I also took issue with Mr. Hevert's capital asset pricing model, largely because it reflected an expected return on the market, which produced an overstated market risk premium, which is a major factor within the capital asset pricing model. The outlook for the expected market risk premium simply was not a rational outlook for what the expected return on the market as a whole was, and correcting that would adjust his CAPM return estimates down to a level more consistent with my own capital asset return model. I also took issue with Mr. Hevert's risk premium analysis, showing that his simple inverse relationship between interest rates and equity risk premiums, while is one factor that can help gauge what the current market risk premium is, it's not the only gauge, and by ignoring other factors that can impact the equity risk premium prevalent in the current marketplace, I found that his risk premium estimate was overstated. I also took issue with Mr. Hevert's proposed use of what is referred to as an empirical CAPM analysis. In constructing that analysis, he used adjusted value line betas within an empirical CAPM framework. There is no academic support for constructing an empirical CAPM analysis that way. When you do, you essentially convert the capital asset pricing model in such a way that it significantly reduces the slope of the security market line. And what that means is it increases the estimated return for low-risk companies like utility companies and decreases the expected return for higher-risk companies, such as those that are measured with more risk than the overall marketplace. The empirical CAPM analysis is generally accepted in academic research when unadjusted betas are used within that framework, but there is no support for developing the ECAPM analysis with a value line adjusted beta. That methodology simply distorts the risk and return relationship in security valuations. I also considered the observable evidence to test the reasonableness of my return on equity finding. I believe there is market evidence that can be used and verified that does give strong indication where the current market cost of capital is. Specifically, the utility's last authorized return on equity of 9.85% was done around 2013. At that time, it's true that authorized returns on equity really haven't changed much since that time, but there's also significant other pieces of observable market evidence that shows that the capital market costs have declined since that time. One example is a comparison of Treasury bonds and utility bonds in around 2013, 2014 to where they are today. Treasury bond yields around that time period were around 3.5%. That compares to around 2.3% today, so that's about a 120 basis point drop. Utility bonds have also dropped. A-rated utility bonds have declined from around 4.5% around that time, around the 2013, 2014 timeframe, to around 3.5% today, so that's about 100 basis points decline. BAA utility bond yields have also decreased by about 100 basis points since that time. There's also an issue of whether or not that decline in bond yield also translates to a reduction in common equity cost. And I offered evidence that shows that there is a relationship between equity cost and bond yields, observable bond yields. more so than just that accepted within the risk premium analysis and capital asset pricing model. But I also compared the makeup of the DCF return, which is an undisputed, generally accepted methodology in this proceeding and frankly across the country, where a required return on utility stock investment is composed of the stock yield and a growth component. Well, the stock yield, that makes it more of a hybrid investment as opposed to a pure equity investment, because an investor gets both current income return plus growth in income. That can be compared to other income investment which don't have the growth component, such as utility bond yields. And I looked at the yield spread between utility stocks and utility bond yields, and it shows that the utility stock prices are adjusting in line with to adjust the utility stock yield to conform to changes in utility bond interest rates. So the utility stock yield component of the DCF analysis is economically logical in comparison to utility bond yields. I also looked at the growth component within the DCF model and found that it's quite robust. It's very high growth rate compared to what the dividend and earnings growth rates have been for the industry historically. That makes sense because utility companies generally are in the midst of very large capital investment programs, which has the effect of growing rate base, and growing rate base grows earnings and dividends. But that growth rate simply can't be sustained indefinitely. Even if there is a sustained period of capital investment by the industry. In my sustained growth rate analysis for my DCF study, I observed that a significant portion of short-term growth outlooks for utility companies is being attributed to the utilities' need to sell new stock in public marketplaces. That's creating kind of a short-term kicker in growth rates over the next 3 to 5 years, maybe a little bit longer than that. But the need, that sustainable growth rate kicker likely will be mitigated over time as sustained levels of large capital investments by utility companies have the effect of growing rate base slower over time. You know, for example, if there is a sustained level of capital investments by the utility that can grow rate base fast initially, but the growth in rate base will slow over time as embedded rate base grows. You know, for example, if you had a $100 million investment, capital investment in rate base, $1 million rate base, then rate base would grow by 10%. If that sustained level of capital investment was maintained for 5 years, in 5 years your embedded investment would grow to about $1.5 million. The $100,000 increment to that would slow the growth from about 10% down to 7.5%. So that growth will subside over time, and that likely will reduce growth. So growth rates right now are quite robust because of the large capital programs that support growth by reinvestment of earnings and cash flows in the utility. It is also supplemented by relatively high levels of growth because they're selling stock to the public to fund large capital investments. So the combination of the relatively competitive yield on stock prices right now with high levels of growth, which are producing indicator returns on the market of less than 9% in the DCF model, is clear evidence to me of the economic logic findings of DCF models measuring the fair market return on equity to being around 9% and frankly a little bit less than that right now. One final factor I looked at was comparing my recommended return on equity to commission authorized returns on equity. The commission authorized return on equity, as Mr. Hebbert noted yesterday, has been around 9.6 to 9.7 for the last 3 years. I explained the difference between my market cost of equity and those commission authorized returns on equity simply by observing that in my judgment, regulatory commissions typically have a policy to gradually reduce the authorized returns on equity down towards the market cost of equity. I think that's been going on for the last 3 to 4 years because market costs have continued to decline over that time. But I think authorized returns on equity should continue to decline even with the gradualistic movement because capital market costs are much lower than authorized returns on equity, while the policy implemented by most regulatory commission, I think, is sound in managing and maintaining a proper balance between investors and customers. That same balance, I think, supports a continued reduction in the authorized returns on equity relative to what we've seen over the last 3 to 4 years. One additional piece of information I offered in my testimony that is relevant, I think, in the gradualistic adjustments to where the authorized return on equity should be in comparison to the estimates of the current market cost of equity, is where market participants think capital market cost might be over the next 5 to 10 years. In my testimony, I show that projections of interest rates in the last 5 years indicated that market participants were expecting increases in capital market cost to bring the Treasury bond yield back over 4% in the 4 to 5% area in 5 to 10 years down the road. The market has now embraced today's low capital market cost as being more sustainable. Those same consensus economists' outlook for changes in interest rates project Treasury bond yields to be in the 3% area 5 to 10% out, 5 to 10 years out, as opposed to 4 to 5% area where they were not too long ago. So I think that's clear evidence that the market has embraced today's low capital market cost as being sustainable, at least in the intermediate period. So I believe my testimony gives clear indication where the current market cost of equity is. It provides a lot of observable market evidence to help provide some logical interpretation of the reasonableness of the results. And it also provides outlooks by market participants and what the market generally is looking at for fair compensation for making investments in this marketplace. That concludes my summary.
Mr. Gorman, thank you for the summary. And to clarify it, you are summarizing your pre-filed direct testimony and rebuttal testimony in this case. Is that correct?
It is, yes.
And those exhibits, would you like to adopt the full explanation that you gave in those direct testimonies as part of your testimony today?
Yes.
Thank you. At this point, I'd like to move for admission of FEA Exhibit 1.0 and Appendix A, as well as the accompanying exhibit, FEA Exhibits 1.01 through 1.19, and FEA Exhibit 3.0 SR, and accompanying FEA Exhibit 3.01 SR.
If anyone objects to that motion, please indicate to me. I'm not seeing any objection in the room, so the motion is granted.
Thank you. Mr. Gorman is available for cross-examination and commission questions.
Thank you. Mr. Meekum, do you have any questions for Mr. Gorman?
I do not.
Mr. Russell? Mr. Snar or Mr. Moore?
No questions, thank you.
Okay, Mr. Jetter?
I have no questions. Thank you.
Okay, Ms. Clark or Mr. Saban?
Just a few, thank you. Mr. Gorman, there should be a binder by your chair that has the exhibits in it. Could you open to your direct testimony, which, is that, do you have a copy of your testimony?
I
your
do,
direct
yes.
testimony? Okay. Let me just state for the record, it's Exhibit FEA, Exhibit 1.0. Could you turn to page 6 of that, please?
I'm there.
Wanted to focus on just one line at the bottom of page 6. You say, while bond rating analysts still have credit rating negative outlooks on certain utilities with marginal cash flows, a majority of the industry's companies, such as DEU, have stable credit rating outlooks because their cash flows, while reduced, are still adequate to support their bond ratings. Did I read that correctly?
You did, yes.
You still agree with that position?
Well, Moody's did downgrade DEU from A2 to A3 since I wrote that testimony. So that, I would have to correct that, but DEU's current revised credit rating from Moody's is still one of the stronger credit ratings within the industry.
In that binder that you just pulled up, would you open up to DEU Exhibit 1.02R?
.02R.
Yes, it should be, it's an exhibit that is attached to Mr. Mendenhall's rebuttal testimony. It's right behind the first, should be right behind the first rebuttal exhibit for the company.
I have it.
Great. You recognize that as a Moody's Investor Service rating action?
I do.
Would you turn to page 2 of that document. About 2/3 the way down the page, the outlook by Moody's has changed for Questar Gas Company from stable to negative, isn't that right?
It's January 18 document, yeah, that's true, yes.
Right, and that predated your testimony by almost a year, isn't that right?
It did, yes.
Okay. Now, if I could have you look at, in that same book, you'll want to find DEU Exhibit 1.05, which was attached to Mr. Mendenhall's direct testimony.
His direct testimony?
Yes. I know there's a lot of paper here. .05.
I'm there.
Okay, and if I could just draw your attention to the date of this. This is January 30th, 2019, right?
Yes,
This is a Moody's Investor Service update and credit analysis.
yes.
If you look down at the second paragraph, it says, Questar Gas credit profile is constrained by very weak financial metrics versus peers. That's right, isn't it?
Yeah, as of January 2019, yes.
Right, and do you have any basis to believe that that's improved since January of 2019?
Well, I heard the company talk about how they were under-earning since the merger in the last case, and by under-earning and being restricted or agreeing to a rate moratorium has had the effect of reducing their earned return on equity, and that would reduce credit metrics. But what this rate case is about is awarding a rate of return, or excuse me, a rate change that will allow for the opportunity to earn the commission-approved rate of return on rate base, which will strengthen those operating incomes and credit metrics.
But that wouldn't be true if the commission adopted your approach and also reduced the capital, the proposed revenue requirement by the company. If it was down to 0 or close to 0, and the commission also reduced the rate of the return on equity as you suggest, both of those would be viewed as negative in the market. Isn't that true?
No, I presented some credit metrics in my testimony that weren't challenged by the company. It showed that at my recommended rate of return in the company's rate-based investment in this case and their level of depreciation expense for the projected test year of 2020 do produce credit metrics that are adequate to support their bond rating.
You think that if the commission approved your approach, that would result essentially in almost an entire reduction of the rate increase being proposed by the company, that would be viewed favorably by the market?
Well, yes. I'm telling you that the evidence the company included in this case, what their operating costs are going to be for calendar year 2020, and what my rate of return and capital structure adjustment will produce operating income, depreciation expense, and cash flow metrics that are adequate to support their bond rating based on Standard & Poor's credit rating criteria. Now, the actual cash flow strength of the utility during the historical period, this is a period where there was a transition related to the acquisition, which may include integration costs into the Dominion system and possibly short-term debt purchases. I don't know, because I didn't look at the historical financial metrics of the utility. Instead, I looked at the rate-making capital structure and cost of service metrics for the utility in the forecasted test year. And what that analysis clearly shows, and was not contested, is that the credit metrics in 2020 will be adequate to support their bond rating.
I'm going to go back to my original question, that line, because I don't think we got an answer on that. Do you have any evidence that the company's credit performance has improved since January?
I have not reviewed the historical credit metrics of the utilities to try to identify why they may have been weak and what opportunities are available to the company to allow them to improve. What I did look at was the company's test year cost of service projections in this case, and looked at the implied credit metrics from that cost of service filing, and found that the resulting credit metrics under my rate of return will be adequate to support their bond rating.
again, I'm going to go back to my question. Do you have any evidence that the company's performance relative to the way that they're viewed by the credit rating agencies has improved since January of 2019?
And I will say again, I do, and that is based on my assessment of the credit metrics for these utilities based on their test year cost of service projections.
And you're aware as of August of 2019, this year, they were downgraded.
From A2 to A3 by Moody's, yes, and again, A3 still leaves them at one of the higher credit rating utilities in the industry.
Well, I guess my point, Mr. Gorman, is since January of 2019, things have not improved, or there wouldn't have been a credit downgrade, isn't that right?
It may simply mean that Moody's believes that they're more in line with an A3 credit rating, a very strong credit rating, as opposed to an A2 credit rating. That does not mean that there's not an outlook for improved credit metrics to support the A3 credit metric rating by Moody's. In fact, when Moody's downgraded them, they did adjust their outlook to stable from negative.
Do you see anything in the Moody's report indicating that they expect improvement in that would move them back up to the credit rating from which they were downgraded?
I see no comment by Moody's about moving. Well, they do indicate opportunities to move up and down.
Yeah,
But my assessment is that the cost of service is more than adequate to support the existing bond rating, which now is A3 from Moody's. And again, that's consistent with one of the stronger bond ratings in the industry.
Final question on that point. Investors, you would agree, I take it, that investors, they rely on what the credit agencies say about the performance of the company when determining whether to invest in those companies. Isn't that right?
Yes.
It's a common resource, right?
It is.
Okay. All right, I want to shift topics now and talk about the capital structure for a moment. Do you understand that the company's current capital structure, its operating capital structure, is at approximately 60% of equity? Its current equity ratio is at 60%.
Well, I looked at that in my testimony, and it was pretty close to 60% through 2018. I'm not sure where it's at right now.
Let me just, subject to check, and you weren't here yesterday, so I'll give you the benefit of the doubt. Let me just represent to you that we had several witnesses testify that the equity portion will remain at 60% this year and throughout 2020. Do you have any basis to dispute that?
Well, I was here yesterday. I just
Oh, you
haven't
were? I'm sorry.
confirmed.
I forgot. You were. That's right. Did you hear that testimony?
I did hear that testimony.
Do you have any basis to dispute that?
I do not.
Okay. So let's take it for, let's stick with that 60%. The company's proposing 55 as its equity portion of the capital structure, correct?
They are.
And you're proposing 52%?
I am.
So if the company is, financially, the company is operating at 60% equity and they're proposing 55, can you explain to me, wouldn't the company want to move down its equity portion at some point? Wouldn't it desire, wouldn't that be a good thing to do because it's actually asking for 55 but operating at 60, and there's a cost to the shareholders of that 5% differential, isn't that right?
I would agree with that.
And so if you're thinking economically speaking, you would try not to have shareholders paying something that they're not going to recover, right?
I think that's the same question, but it would be prudent for the company to adjust its actual cost down to what the commission finds to be reasonable cost for recovering in rates.
So the company should, if it's thinking rationally and has the ability to do it, it would want to move down as much as possible so it's not having shareholders cover something that they don't recover from customers, right?
I believe that's the intent of rate making, that when costs are unreasonable or excessive, then management has the obligation to try to adjust their actual cost to conform to what the commission finds to be appropriate for setting rates.
So do you think it's a fair assumption then, if that's, if we assume the company is economically reasonable or acting economically in an economically reasonable way, that there's other constraints that are preventing that from being moved down to 55% or even moved down to 52% as you suggest?
Well, I don't know if there's constraints or simply financial objectives trying to be set by the company, which may be at odds with the most accurate management of cost of capital on behalf of customers. So I don't know if it's constraints or simply outlooks for the company and attempting to estimate how much income might be available to start paying dividends at some point up to the parent company.
It's also true in the Moody's documents we've reviewed that Moody's looked favorably on the company taking the action of having a higher equity portion to stabilize its credit metrics. Isn't that right?
It's true, and I believe Moody's also opined that the company's proposal for a 55% equity ratio may not be approved in this case.
That's right.
So I think all of that's an outlook by Moody's when they established that this company has a relatively strong bond rating of A3 with a stable outlook.
And finally, would you also agree that if the company wanted to move down its equity portion to the level at which you're suggesting, that would come at a substantial cost to the company? They would have to go find the ability to either, to dividend up, so to speak, is what we heard yesterday. It's shareholders to get that debt to equity ratio down. It's true, isn't it?
Well, I don't agree that that's necessarily a cost to the company. Dividending from the subsidiary to the parent company is not a negative thing for the parent company, it's positive. But there would be a need to restructure their capital structure that in order to provide them with an opportunity to earn the authorized return on equity.
They'd have to come up with a significant amount of cash, right?
Well, there's a significant amount of capital investments planned for 2020. So the combination could be some dividend payment to readjust embedded capital structure, but to use predominantly debt capital in supporting the incremental plant investment the utility has planned for 2020. That would allow them to rebalance their capital structure in line with what the commission finds to be appropriate for setting rates.
Have you done any analysis in your testimony to identify what that cost would be? How much the company would have to incur in either debt or some other form of financing to make that restructuring happen?
There would not be a cost of issuing a dividend to the parent company. There would be debt issue cost associated with issuing additional debt to the market. I have no reason to believe that because this capital structure is in line with industry norms that I'm proposing, there would be anything more than normal debt issue cost associated with that capital structure rebalancing.
And all I'm asking is, have you calculated that amount?
I have not.
We have no further questions at this time.
Major Kirk, any redirect?
No, sir.
Commissioner White, do you have any questions for Mr. Gorman?
I have no questions, thank you.
Commissioner Clark?
Mr. Gorman, thanks for the summary, in particular the context that you placed your modeling work in, and that's a dense area, and I'm always grateful when people make some effort to simplify that for us or provide some additional explanation. But I'd like to talk with you more qualitatively. You referred in your summary to the overall risk characteristics of DEU, and I just wanted to hear you elaborate on those characteristics as you perceive them in relation to peer companies and the relative riskiness of the enterprise.
Thank you. Happy to. I discussed the investment risk characteristics of DEU and the industry in my testimony. I observe what the credit standing is for both electric and gas utilities. I look at authorized returns on equity. I look at comments of the credit analysts, which are probably the most independent body that assesses investment risk for utility companies, if there truly is an independent body. They're the closest thing we have to it. Credit analysts have stated concern about the change in the federal tax law that has reduced utilities' cash flows. Standard & Poor's noted that the change in cash flows is notable, but there is no threat to the credit standing of the utility. Moody's initially put the utility industry on negative outlook because it wasn't quite sure what the impact on cash flows would be. but that negative outlook was revised more recently to a stable outlook, recognizing that cash flows have been reduced, but cash flows are still relatively strong for the industry as a whole. Authorized returns on equity in the 9.6 to 9.7 over the last 5 years have supported strong credit outlooks, have supported access to significant amounts of capital under reasonable terms and prices to support very large capital programs across the industry in general. More recent authorized returns on equity, and I mean more recent about the last, within 2019, particularly in the Pacific Northwest, we're seeing regulatory commissions move below that 9.6, 9.7 area down to the 9.3, 9.5 area for a lot of Northwest electric utility, or electric and gas utilities specifically. But we're starting to see other jurisdictions start to reduce the authorized returns on equity below the 9.6, 9.7% area. With that reduction in authorized return on equity, I'm not aware of any reduction in credit standing for any of those utilities or limitations on any of those utilities to access capital to continue to fund their large capital programs under reasonable terms and prices. And I'd also note that the rate-making capital structures that aligned with those authorized returns on equity have included common equity ratios of around 49 to 52%. There's very few that go much above 52% for rate-making purposes. Again, that's notable and observable evidence of what the market finds to be appropriate rate-making decisions by regulatory commissions that support the utility's credit standing and ability to support very large capital programs. Stock performance of utility companies has been very robust over the last 5 years. While it's generally recognized that utility companies are below market risk investments, the stock performance of regulated utility companies has actually outperformed the market in many instances, but still has been more stable because it doesn't drop as much as the market drops in down markets. And more recently, it actually has gone up more than the market during the up markets. But they're generally regarded as relatively stable investments. And the market has been supportive of increased valuations of utility stocks more recently. So from an industry standpoint, recognizing what the trend in authorized rates of return are for return on equity and common equity ratio, they are meeting the Hope and Bluefield standards of maintaining credit, maintaining the utility's access to capital, maintaining financial integrity, and most importantly, doing so under just and reasonable prices to retail customers. For Dominion specifically, I also reviewed some of the risk characteristics of that company and did observe that, they made quotes about what Standard & Poor's specifically is saying about Dominion Energy Resources. And at the time I did my analysis, Standard & Poor's had a stable credit rating outlook for Dominion Energy Resources. I should have been more careful about quoting Moody's because its outlook for this utility was negative at that time. But importantly, the negative outlook related to an A2 bond rating from Moody's. That is one of the strongest bond ratings in the industry. When Moody's adjusted that bond rating down to A3, it changed its outlook to stable. So this utility still has one of the stronger bond ratings in the industry, and now its bond rating outlook is stable. It's important to know what bond rating was rated as negative by Moody's and what bond rating is rated as stable by Moody's, and how that bond rating relates to other utilities within the industry. An A3 Moody's bond rating is a very strong bond rating, and right now Moody's believes it to be stable. And it believed it to be stable where the credit metrics were impacted by whatever was going on with this utility as it transitioned from the acquisition of Questar to Dominion Energy Resources, and it went through the rate moratorium period where the company acknowledges that it was not earning its authorized return on equity. By not being able to file a rate case to adjust rates to give you the opportunity to earn your return on equity, that will have a negative impact on your credit metrics. And that was being noted by the credit rating agencies during that time period. If we look at the 2020 test year, the credit metrics are not weak for this utility, with a balanced capital structure of 52% equity and a return on equity more in line with authorized returns on equity. again, within my testimony, I provide all that evidence and also observe what other commissions are doing in terms of a gradual movement to adjust the return on equity down to the current market cost of equity, which is conservatively 9%, I believe. And most of those regulatory commissions now are starting to move under the 9.6 to 9.7 ROEs that have been in place for the last 5 years. And I believe that is in part because market participants have now moved away from the expectation of increasing capital market cost over the next 5 years, have now embraced that capital market cost levels are low today and going to stay low for at least the next 5 to 10 years.
Thank you. That's my only question.
Thank you.
Thank you. I don't have any additional questions, so thank you for your testimony this morning. Anything else, Major Kirk?
No, sir, thank you.
Okay. Why don't we take a 10-minute break, reconvene at 10:45, and then if there's no objection, I think we'll go to Mr. Meekum for his witness at that point. think we'll start again, and we'll go to Mr. Meekum.
Thank you very much, Mr. Chair. ANGC calls Mr. Bruce Oliver.
Good morning, Mr. Oliver.
Good morning.
Do you swear to tell the truth?
I do.
Thank you.
Good morning, Mr. Oliver.
Good morning.
Could you please state your name and business address for the record, please?
My name is Bruce Richard Oliver. My business address is 7103 Lake Tree Drive, Fairfax Station, Virginia.
Thank you. And did you prepare and cause to be filed direct testimony in this proceeding, which we have pre-marked as ANGC Exhibit 1 with attachment A that describes your experience and your resume with associated exhibits ANGC 1.01 through 1.05?
I did.
Thank you. And did you also cause or prepare and cause to be filed surrebuttal testimony in this proceeding, which we have pre-marked as ANGC Exhibit 1 SR?
I did.
Do you have any corrections to that testimony?
Just one. On the cover of the surrebuttal testimony, it inadvertently referenced class cost of service and rate structure issues. It should state return on equity and capital structure issues.
Thank you. And is there anything else you'd like to correct?
I don't believe so.
And are you adopting that testimony as your testimony today?
I am.
Thank you very much. Do you have a summary, a brief summary of your background and experience? Perhaps you could share that with the commission.
I do. I have more than 45 years' experience in energy and utility regulatory matters, including testimony on a wide range of rate and regulatory policy issues for gas, electric, and water utilities. For more than 25 years, I served as the primary technical consultant on gas rate issues for the Rhode Island Division of Public Utilities. I also assisted the Delaware Public Service Commission on numerous gas and electric rate proceedings over a period of more than 10 years. I have served in management positions for two major investor-owned utilities, the Pacific Gas and Electric Company and the Potomac Electric Power Company. And I have held senior consultant, management, and executive positions in 3 consulting firms. I have testified in over 300 regulatory proceedings spread across 25 jurisdictions, from Arizona to Vermont, from California to the Middle Atlantic states, and many states in between. As a consultant, I have represented a diverse set of clients, including regulatory commissions, residential consumer advocates, commercial, institutional, and industrial rate case interveners, municipal governments, and municipal governments. I have also consulted for such organizations as the U.S. Department of Energy, the Environmental Protection Agency, the Electric Power Research Institute, and the World Bank. My rate case testimonies have addressed an array of topics, including, but not limited to, revenue requirements, cost of capital, capital structure, class cost of service allocations, and rate design. I have also submitted testimonies addressing utility mergers and acquisitions, revenue decoupling, divestiture of generation assets, gas procurement planning, the economics of large-scale power purchase agreements, rate unbundling, incentive rate making, economic development, rate adjustment mechanisms, and the development of gas transportation rates and policies. In addition, I advise a large number of commercial and institutional energy users on how to procure energy how to procure natural gas and electricity in competitive markets, and how to evaluate competitive energy supply options.
Thank you. And do you have a brief summary of your testimony, please?
Rate of return, or return on equity, and capital structure are the two most important revenue requirements issues in this proceeding. DEU's requested ROE is substantially overstated. The 10.5 ROE that DEU witness Hevard recommends is not reflective of current financial market conditions, is premised on holding company equity returns, and does not properly reflect the risks faced by gas distribution utilities. His recommendation is also inconsistent with other recent comparable gas distribution utility ROE determinations. DUE's ROE should be set in a manner that is more reflective of current market conditions and the risks faced by DUE's regulated gas distribution operations in Utah. DUE's proposed capital structure in this proceeding places unnecessary and inappropriate cost burdens on the company's ratepayers in Utah. The company's actual capital structure is even worse. Despite the company's representations to the contrary, its actual capital structure is of little relevance for rate-making purposes in this proceeding. For rate-making purposes, the equity component of DEU's capital structure should be set to reflect a more optimal use of the company's capital resources and to minimize the costs of capital borne by Utah ratepayers, and do so in a manner consistent with sound financial management. As I have demonstrated in ANGC Exhibit 1.05, appropriate adjustments to DEU's ROE and capital structure will eliminate most, if not all, of the company's need for additional revenue in this proceeding. In my direct testimony, I present ANG Exhibit 1.01, which documents a much lower current yield on U.S. Treasury bonds than witness Hevard used in his direct testimony. Since early summer of this year, both current and projected yields on 30-year U.S. Treasury bonds have fallen noticeably. Witness Hevard's rebuttal testimony reflects that decline in yields on 30-year Treasury bonds and shows that they have fallen even further. Witness Hevard's direct testimony used a current yield on 30-year Treasury bonds of 2.92%. His rebuttal shows a current yield on 30-year Treasury bonds of 2.11%. That is a decline in his own testimony of 81 basis points. Yet this decline is not reflected in any change in his ROE recommendations. The upward bias in witness Hevard's ROE recommendations must be recognized. My direct testimony documents the basis for this upward bias in ANGC Exhibit 1.02. That exhibit indicates that on average, witness Hevard's ROE recommendations have been 78 basis points above the levels that the commissions in the cases in which he testified made determinations. So the difference between his recommendation and what the commissions ultimately decide, on average over the last 3 years, has been 78 basis points. That's substantial. However, this observation is offered not to suggest that this commission should simply take witness Hevard's recommendation of 10.5 and subtract 78 basis points. Rather, it is offered as evidence of a substantial and persistent upward bias in his recommendations. This commission must make an ROE determination in this case on the basis of the record presented in this case and not regulators' determinations in other cases. Reliance solely or primarily on determinations by regulators in prior proceedings does not properly account for differences in financial and operating characteristics of utilities, nor does it address the influence of more recent changes in financial markets, such as the decline in U.S. Treasury bond yields that I previously referenced. Witness Hebert also relies inappropriately on data for holding companies. We must remember that there are often substantial differences between the risks faced by holding companies and the risks faced by gas distribution utilities. Holding companies often have unregulated, non-utility activities that have no assurance of cost recovery and often considerable market uncertainties and competitive risks that are not faced by gas distribution utilities. By contrast, gas distribution utilities frequently have an array of rate-making mechanisms, such as weather normalization adjustments and capital trackers that are not available to non-utility subsidiaries of holding companies. The differences between utility and non-utility risks must not be overlooked. It is not sufficient to look at utility ratings on holding company debt instruments and conclude that the risks on holding company and utility debt instruments and conclude that the equity risks faced by utilities and their holding company parents are the same. The experience of Northwest Natural Holding Company, cited in my direct testimony, provides demonstration of the importance of this difference. In 2017, Northwest Natural Holdings incurred a $198 million write-off in a non-utility gas storage operation. Although the regulated gas distribution utility operations within Northwest Natural Gas were the company's primary source of earnings, the write-off related to its non-utility gas storage operations was large enough to equate to more than 3 times the annual earnings from its gas distribution utility operations. Although that write-off had no impact on Northwest Natural Gas Holdings' gas distribution utility earnings or equity risk, it had a significant impact on the holding company's finances. The Hope and Bluefield decisions mandate that utility equity returns reflect returns earned on comparable risk investments. But gas distribution utility risks and holding company risks for equity investors are not comparable. This puts us into a situation where all rate analysts have to grapple with the problem that we only have market data for holding companies, yet it's the role and purpose of regulatory proceedings to set equity returns for distribution companies. And it is extremely difficult to accurately quantify what the impacts of that difference in risk are given the limited data available. But in your judgmental considerations and your weighing of the evidence, you have to take rates of return that are estimated based on holding companies and edge them downward, at least some, to recognize that distribution utilities are much less risky investments. The Commission's capital structure considerations in this proceeding must start with recognition that the effective cost of equity for gas distribution utilities is significantly greater than the cost of debt. The company's filing in this proceeding shows a cost of debt of 4.37%, a weighted average cost of debt. Witness Hebert's recommendation for ROE is 10.5%. That means that the cost of equity that ratepayers ultimately bear is more than 2 times the cost of debt. we hear a lot of concerns about, well, if you cut the cost of equity, it's going to increase our debt costs. If you'll excuse the analogy, if I go to the gas station and I have to pay $2 more per gallon for gasoline, I get upset. But if I go and it's a 10-cent or 20-cent variation, I can live with that. Well, that's what we're looking at by comparison when we compare the costs of debt and equity and the impacts of changes in debt ratings. Nobody in this case has recommended an common equity percentage less than 50%. And within the range that we're talking about here, we're not talking about extreme movements in the cost of debt capital. Certainly nothing that would cause the cost of debt to even come close to rivaling the cost of equity. The cost of equity remains an expensive option for the utility and a very expensive option for ratepayers, because whatever you pay to equity holders for rate-making purposes has to be grossed up further for taxes. The effective cost of equity to a ratepayer is about 2.4 times the cost of debt. So you have a lot of room to accept somewhat lower debt ratings. And as Mr. Gordon pointed out, even with recent lowering in the company's debt rating, it's still a very strong debt rating. But you can do that without jeopardizing and still provide substantial savings to ratepayers and not jeopardize sound financial management for the utility. A key shortcoming in the company's presentation in this case is that nowhere do they address the impacts of their capital structure decisions on ratepayers and the costs that they impose on ratepayers. Yet that's a key role of the Regulatory Commission in evaluating an appropriate capital structure. You have a fiduciary responsibility to ensure that rates charged to customers are just and reasonable. And if the equity percentage is inflated and the overall cost of capital are much higher because you don't control the cost of equity or the percentage of equity, then that's the Commission's responsibility. A rational investor would look at the cost of debt and the costs of equity and say, we need a better balance in how these costs are structured for rate-making purposes. And I say for rate-making purposes because a utility has tremendous influence and control over what their actual capital structure is. And regardless of where you set the capital structure for rate-making purposes, the actual capital structure can and most often will be different. For some utilities, the variations are much larger than others, but rarely is it exactly what's approved for rate-making purposes. Well, the company complains that, oh, well, we have all this equity and we'll be losing $8 million of return. That's their choice. The holding company has decided that they want to keep extra equity within this entity. The presumption is that the holding companies, and we talk about shareholders, but Dominion Energy Utah only has one shareholder, and that's Dominion Energy, Inc. And Dominion Energy, the presumption is Dominion Energy, Inc.'s shareholders could get a better return in another investment. But is that the case? Would they have put 60% equity into Dominion Energy Utah if they could get a better return on their other investments? I don't think so. When we look at the company's exhibit 3.31, which lays out the components of the company's capital structure since the decision in 2013, we find that the company's overall capitalization has increased 78%, has increased, lost my number here. I believe it's 78% over that period. Of that increase in overall capitalization, the vast majority of it has come from equity. The company has had $360 million approximately of retained earnings over that period and $200 million of an equity infusion paid in capital. So over $560 million of the 700 and some million of capital additions has come from equity. Now, why has the company used such a disproportionate amount of equity in the most recent period? Well, you could argue, and we've heard arguments in this proceeding, that when a company has credit problems, one way to address that is by increasing the equity percentage, right? But over the last several years, Dominion has increased their equity percentage, but their credit concerns haven't gone away. Why is that? Well, it's because Dominion has used its retained earnings and its equity infusions disproportionately to fund its capital expansion and left itself with insufficient liquidity. If it had retained more of its retained earnings or capital infusion in cash or more liquid assets and borrowed some of the funds for capital expansion, their credit metrics would be improved. It's that simple. I think the bottom line is that DEU's concerns are regarding its credit ratings and its capital structure are of its own making and do not justify the higher common equity percentage in its capital structure. DEU's entire capital structure presentation lacks sensitivity to the customer impacts of its proposal. Instead, the company relies on speculative assertions about future credit impacts to support its position that it needs more equity. You know, we're not talking, and even the company's witnesses weren't saying that if we have a lower credit rating, we're going to have vastly higher debt costs. What they're saying is, well, maybe in the future, if the market turns down, we might have a problem. I respect that, and that's a consideration all financial managers have to address. But it doesn't justify the vast additional costs that we're putting on ratepayers by carrying a higher equity percentage. When you look around at neighboring utilities, and I point you to Witness Hevered's Table 10, two of the utilities, the operating utilities cited in there are Southwest Gas and Northwestern Natural Gas. Well, both of those companies are operating with less than 50% equity ratios. And yet both of them have current credit ratings equal to or better than those for DEU. And yet, when you look at the recent returns that are cited by Witness Hevered in his rebuttal exhibit 2.09R, you find that the authorized rates of return range from 9.50% to 9.25%, well below his recommendations in this case. This commission needs to act and act significantly to lower the cost of the return on equity, the cost of equity in this case, and reduce the amount of equity in the company's capital structure for rate-making purposes. The company can maintain whatever it believes is appropriate for its operational purposes, for its own company strategy purposes, but for rate-making purposes, the equity percentage needs to be reduced. Thank you.
Thank you, Mr. Oliver. Does that conclude your summary?
It does.
Then I would move the admission of A&G Exhibit 1 with attachment A and A&G Exhibits 1.01 through 1.05 and A&G C 1SR.
If anyone objects to this motion, please let me know. I'm not seeing any indication, so the motion is granted.
Thank you. Then Mr. Oliver is available for cross-examination.
Thank you. Major Kirk, do you have any questions for Mr. Oliver?
No questions, thank you, sir.
Mr. Russell, do you have any questions for this witness? Mr. Snar or Mr. Moore?
No questions, thank you.
Mr. Jetter?
I have no questions.
Ms. Clark or Mr. Saban?
We have no questions of this witness, thank you.
Okay, Commissioner White?
No questions, thank you.
Commissioner Clark?
No questions, thank you.
I think I just have one or two on your Exhibit 1.02.
Yes.
Just to make sure I'm understanding that. These are all cases that Mr. Hevert participated in as a
Absolutely,
witness?
yes.
Are these illustrative or exhaustive? Is this an exhaustive?
Exhaustive
It's
for that
ex-
time period.
For the exhaustive
Yes.
for the time period. Do you, the chart doesn't have this, but I was
Now,
asking if you.
I have to caveat that because I bring it up into 2019, and since I filed the testimony or, in more recent periods, there may have been some decisions I didn't pick up.
Exhaustive up into at least
The time that I
April of
filed my
20, at
testimony.
least up until April of 2019 is the most recent on this. Okay.
Yeah.
The only other question I have, this chart does not indicate what the approved ROEs were prior to these decision points.
No, it
Do you
does
know
not.
off the top of your head if any of them were increases or maintaining the same level versus decreases?
In general, they've been at least slightly downward, but there are always exceptions.
There are probably some exceptions.
Yes.
Okay, thank you. That answers all my questions.
Okay.
Thank you for your testimony this morning.
Thank you.
Mr. Beacom, anything else from your client?
No, that's it.
Okay. Mr. Snar or Mr. Moore, were there timing concerns with any of your witnesses? There was some discussion after the hearing yesterday that there might be.
We have two expert witnesses from out of town. I think their flight arrangements are after we conclude today, but it presumes that we conclude today, and we want to make sure that happens for them.
Okay. Well, do you have any objection to moving back to what the order that we typically go in at this point? And going to the division next, or would you like to present your witnesses now?
I think we can go with the regular routine.
Okay. Well, then I think we'll move to Mr. Jetter to start your witnesses at this point.
Great. The division would like to call and have sworn in Douglas Wheelwright.
Good morning, Mr. Wheelwright. Do you swear to tell the truth? Yes, I do. Thank you.
If I may, before I begin my direct examination of Mr. Wheelwright, I have an exhibit yesterday that was discussed as DPU cross exhibit number 2 that I believe I did not enter into the record. And so, given that, I'd like to move at this time to.
Can you remind me what that exhibit was?
That was a investor presentation from December 2nd from Dominion Energy Incorporated. Yes.
If anyone objects to this motion, please indicate to me. I'm not seeing any objections, so the motion's granted.
Thank you, Mr. Chairman. I don't recall, I apologize, if Mr. Wheelwright has been sworn in.
Yes, he has been.
Great. Mr. Wheelwright, would you please state your name and occupation for the record?
My name is Douglas Wheelwright. I'm a technical consultant supervisor for the Division of Public Utilities.
Thank you. And in the course of your employment with the Division of Public Utilities, did you have the opportunity to review the application along with the filings of the various parties in this docket?
Yes, I did.
And did you create and cause to be filed with the commission pre-filed direct testimony along with DPU exhibit number 1.0 direct?
Yes.
If you were asked the same questions that are contained in that pre-filed testimony today, would your answers remain the same?
Yes, they would.
And would you adopt that as part of your testimony today?
Yes, they would.
I'd like to move to enter into the record the pre-filed direct testimony of Mr. Wheelwright along with the exhibit that was attached.
If anyone objects to the motion, please let me know. I'm not seeing any objection in the room, so the motion's granted.
And Mr. Wheelwright, have you prepared a brief summary of your testimony and the division's position in this docket?
Yes, I have.
Please go ahead.
Thank you. Good morning, Commissioners. Questar Gas Company, doing business as Dominion Energy Utah, originally requested an increase in its Utah rates of $19.2 million. The company is asking for an increase in the authorized rate of return on equity from 9.85% to 10.5%, an increase in the infrastructure tracker program, and an increase in the proposed capital expenditures. In rebuttal testimony, the company has accepted a few of the adjustments provided by other parties and has revised the request to $17 million. The division has reviewed the testimony and exhibits of company witnesses, as well as the testimony and exhibits of the intervening parties. The division has participated in meetings with company representatives to obtain additional information and clarification on multiple topics, and has submitted numerous data requests. Representatives from the division have also reviewed the data requests and that have been submitted by other parties and the corresponding response from Dominion Energy Utah. The division does not agree with or support the company's calculation of the deficiency in the revenue requirement for the test year. In total, representatives from the division have identified $19.6 million in adjustments to the proposed revenue requirement, and the specific details of each adjustment has been provided to the Commission in written testimony. The company has accepted the division's $1.5 million adjustment to the lead lag calculation, leaving two of the division's adjustments remaining, that is capital spending and the return on equity calculation. The two remaining adjustments total $18.1 million, which calculates a revenue surplus of $1.1 million. In this proceeding, the division will provide witnesses to address each of the specific adjustments. David Thompson will address the lead lag adjustment. Jeff Einfeld will address the audit of the tracker program. Eric Wharton will address the proposed increase in the tracker budget and capital expenditures. And Casey Coleman will address the return on equity calculation. And that concludes my summary.
Thank you. I have no further questions for Mr. Wheelwright, and he's available for cross-end questions from the Commission.
Okay, thank you. Mr. Moore, do you have any questions?
No questions, thank you.
Major Kirk?
No questions, sir.
Mr. Meekum?
No, thank you.
Mr. Russell?
No questions.
Ms. Clark?
The company has no questions. Thanks.
Okay, Commissioner Clark?
No questions. Thank you.
Commissioner White?
No questions, thank you.
None from me either. Thank you for your testimony this morning, Mr. Wheelwright. Mr. Jetter, your next witness.
Thank you. The division would like to next call David Thompson.
Good morning, Mr. Thompson. Do you swear to tell the truth?
I do.
Thank you.
Mr. Thompson, would you please state your name and occupation for the record?
My name is David T. Thompson. I'm a technical consultant for the Division of Public Utilities.
Thank you. And in the course of your employment with the division, have you had the opportunity to review the application filed by Dominion Energy Utah along with the various filings of other parties in this docket?
I have.
And did you, with that knowledge, did you create and cause to be filed with the commission direct testimony along with 8 exhibits that are titled DPU exhibits numbers 4.0 through 4.8 direct?
Yes, I did.
And if you were asked the same questions in your pre-filed direct testimony today, would your answers remain the same?
They would.
I'd like to move at this time to enter the direct testimony along with the attached exhibits of DPU witness Thompson into the record.
If anyone objects to the motion, please let me know. And I'm not seeing any objection in the room, so the motion is granted.
Thank you. Mr. Thompson, have you prepared a brief summary of your testimony?
I do.
Please go ahead.
Good morning, Commissioners, and thank you for the opportunity to briefly review the division's changes to the company's lead lag factor used to estimate cash working capital in this rate case. In my direct testimony, I stated the company's filed lead lag study indicating net lag days of 7.358 should be adjusted to show net negative lag days of 0.828. Using the division's proposed negative 0.828 negative lag days reduced the company's adjusted revenue requirement by $1,496,508. The division made 4 adjustments to the company's lead lag study. These adjustments were explained in my direct testimony and were summarized in my DPU Exhibit 4.8 DIR. As has been stated a couple of times in this hearing, the company has accepted my adjustments. And this concludes my testimony.
Thank you. And I have no further questions. Mr. Thompson is available for cross and commission questions.
Okay, thank you. Mr. Moore or Mr. Snar?
No questions, thank you.
Major Kirk?
No questions, thank you, sir.
Mr. Meekum? Mr. Russell?
No questions.
Ms. Clark?
No, thank you.
Commissioner White?
No questions, thanks.
Commissioner Clark?
No questions. Thank
I don't have any either. Thank you for your testimony this morning.
And the division would next like to call its next witness, Mr. Jeffrey Einfeld.
Good morning, Mr. Einfeld. Do you swear to tell the truth?
Yes.
Thank you.
Good morning, Mr. Einfeld. Would you please state your name and occupation for the record?
My name is Jeffrey S. Einfeld. I am a utility analyst for the Division of Public Utilities.
Thank you. And in the course of your employment with the division, did you have the opportunity to review the application and materials filed in this docket?
Yes.
And I'm not sure that a lot of that relates, in fact, directly to your testimony in this docket, but did you create and cause to be filed direct testimony along with one exhibit that is titled DPU Exhibit Number 5.0 DIR?
Yes.
And would you answer the questions that were posed in your direct pre-filed testimony the same if they're asked today?
Yes.
Given that your direct testimony was a summary in itself, I won't have you provide a summary today. Do you have any corrections or changes you'd like to make to your pre-filed testimony?
No.
Thank you. With that, I would like to move to enter into the record the direct testimony and exhibit attached to that from Mr. Einfeld.
If anyone objects to the motion, please let me know. And I'm not seeing any objection in the room, so the motion is granted.
Thank you. And I have no further questions. Mr. Einfeld's available for cross or questions from the commission.
If anyone has cross-examination questions for Mr. Einfeld, would you indicate to me? I'm not seeing any indication. Commissioner White, do you have any questions?
No questions, thank you.
Commissioner Clark?
No questions.
I don't have any either. Thank you for your testimony this morning.
Thank you.
The division would like to next call and have sworn in its fourth witness, Eric Orton.
Good morning, Mr. Orton. Do you swear to tell the truth?
I do.
Thank you.
Thanks.
And good morning, Mr. Orton. Would you please state your name and occupation for the record?
My name is Eric Orton. I'm a technical consultant for the Division of Public Utilities.
Thank you. In the course of your employment with the division, have you also had the opportunity to review the application filed by the commission along with the filings from other parties?
the application filed by the
Oh,
company.
excuse me. Yes, the application filed by Dominion Energy Utah.
I did.
And with that knowledge, did you create and cause to be filed with the commission direct testimony along with DPU exhibits 2.0 direct through 2.5 direct and surrebuttal pre-filed testimony with exhibit DPU exhibit number 2.0 surrebuttal?
I did.
Do you have any corrections or changes you would like to make to any of that pre-filed testimony?
I do have 2 corrections to my pre-filed direct testimony.
Please go ahead. Well,
Thank you.
actually, let me have you hold off until everyone who's interested is ready. Please go ahead.
Line 351. Currently references columns L and M. It should reference columns K and L. Also, the next page, line 354, I need to delete the reference in parentheses, so we would remove paren, line 2, column L, and close paren. Those are all the corrections I'm aware of.
Thank you. With that, I'd like to move to enter the direct and rebuttal testimony along with the exhibits into the record.
If anyone objects to the motion, please indicate to me. I'm not seeing any objection in the room, so the motion's granted.
Thank you. Have you prepared a brief summary of your testimony?
I have.
Please go ahead.
Thanks. In my direct testimony, I researched 4 claims or proposals made by the company in its application. First was a proposal to increase the infrastructure tracker budget to $80 million in 2020. The tracker is functioning as it should, and increasing the budget in this manner is unmerited and not in the public interest. So as such, I recommended that that request be denied. Second, the proposed change to the current method of reconciling the over or under budget variances of the tracker spending. I recommended adopting the company's proposal on a trial basis. Third, I address a capital budget proposed in the test year. I looked at the annual trend for the company's capital spending, the amount the company was awarded compared to what it spent, and the justification for that amount. This drove the conclusion that I couldn't support the proposed 2020 capital budget, and therefore I proposed to reduce that amount to a more appropriate level. Finally, I addressed the company's claim that it had kept all its mergers agreements. I pointed out that it had not. That issue has since been resolved in the 19-057-25 docket, ordered just 2 weeks ago. My rebuttal, or my surrebuttal testimony doesn't change any of my positions. Thank you.
Thank you. I have no more further questions for Mr. Orton. He's available for cross and commission questions.
Thank you. Mr. Moore or Mr. Snar, do you have any questions for Mr. Orton?
No questions.
Major Kirk?
No questions, sir.
Mr. Meekum? Mr. Russell?
No questions, thank you.
Thank you. Ms. Clark?
I have just a few. And I will be asking Mr. Orton about a couple of cross exhibits. May I approach and just provide you with both?
Yes.
Mr. Orton, I've just provided you with two exhibits. One is labeled as DEU Hearing Exhibit 9, and another is labeled as DEU Hearing Exhibit 10. I'd like to draw your attention to Hearing Exhibit 9. It is a PowerPoint presentation. Do you recognize
I
that?
have that. Well,
And do you recognize that? Do you know, can you describe what it is?
Excuse me, might we have a copy or two of that?
Oh, I'm so sorry.
Thank you.
And I've got extra 10.
Extra everything. Okay, here. They're right here, Cameron. Thank you. My apologies. Sorry. Mr. Orton, would you please describe DEU Hearing Exhibit 9?
it appears to be the slide deck, a printed copy of the slide deck of a feeder line technical conference of 10 years ago.
In docket 19, I'm sorry, 09-057-16, is that correct?
That's what it looks like, yeah.
And would you agree, subject to check, that this was presented within that docket?
I assume it was.
Can I have you turn to pages 20 and 21 of Hearing Exhibit 9?
I have it.
And as you're looking at those two pages, does that represent the scope of the feeder line replacement schedule as it stood in 2009?
If you say it does, I
Subject to
assume I don't have anything to contradict that.
When you testified in this matter, Mr. Orton, that initially the feeder line replacement program was intended to be completed in 9 years, is that consistent with these two pages?
It is not.
It is not.
It is.
It is. Okay.
I was looking at the wrong column.
No, I understand.
So yes, that would be right.
And to your knowledge, was the commencement of the feeder line replacement program, did that occur in 2009?
The tracker program did. The feeder line replacement started in about 2002.
Thank you for that clarification. Fair enough. I'd like to turn your attention then to DEU Hearing Exhibit 10 and ask you if you recognize what that is.
I've seen several of these, yes. It's, well, the company files on an annual basis at least the schedule for their feeder line replacements.
And would you agree, subject to check, that this is the most recent schedule for the feeder line replacements?
That's probably right.
And you would agree with me, wouldn't you, if you were to compare pages 20 and 21 of Hearing Exhibit 9 to Hearing Exhibit 10, there are substantially more feeder lines included now than at the commencement of the program.
Yeah, I think we've talked about that in the past.
And it's your recollection that in 2013, more feeder lines were added to that program?
That's true.
And is it your recollection also that in 2013, the belt lines in the company system were also added? So you would agree that the feeder line replacement program is larger in scope than it was in 2009?
It is larger in scope.
I would move to admit DEU Hearing Exhibits 9 and 10.
And just one question in an abundance of caution, I'm sure I know the answer to this, but page 25 has some yellow highlighting that I assume is not intended to be confidential material. But I just wanted to check with you before we enter it into evidence.
Let me double check. Which page are you looking at?
Page 25 of the presentation from the tech conference.
That is correct.
It's not confidential.
It is not confidential, correct.
If anyone objects to the motion, please indicate, Jimmy. I'm not seeing any objections, so the motion's granted.
Thank you. Mr. Orton, I just wanted to ask you a couple of questions about the capital budget. You've taken issue in your testimony with the capital budget.
Right.
Would you agree that the capital budget for 2020 is approximately $44 million higher than the prior capital budget?
I think that's about right.
And would you agree that the $44 million is made up in part of the proposed increase to the feeder line tracker, the increase that you oppose? Is that correct?
Right.
Would you agree that if the commission approved that increase in the feeder line budget, the capital budget should have a commensurate increase for whatever that increase approval was?
I don't know how else you'd pay for it.
Okay. Would you also agree that the remainder of that $44 million is made up largely of the $20 million Southern System expansion and the $14 million Kern River tap?
I'm not sure that's the difference. Those are included in that budget, I believe, but I'm not sure they are the difference. They are certainly major parts of the 2020 budget.
Fair enough. You have not taken issue with either of those projects in this proceeding, have you?
I have not.
Okay.
I haven't had the information. No.
I don't have any more questions. Thank you.
Any redirect, Mr. Jetter?
No redirect, thank you.
Okay, Commissioner Clark, any questions for Mr. Orton?
No questions, thank you.
Commissioner White?
No questions, thank you.
All right.
Neither. Thank you for your testimony this morning.
Okay, thank you.
Mr. Jetter?
Thank you. The division would like to call and have sworn in Mr. Casey Coleman.
Good morning, Mr. Coleman.
Good morning.
Do you swear to tell the truth?
Yes.
Thank you.
Mr. Coleman, please state your name and occupation for the record.
My name's Casey J. Coleman, and I am a technical consultant with the Division of Public Utilities.
Thank you. And in the course of your employment with the division, did you have an opportunity to review the application made by Dominion Energy Utah in this docket, as well as the filings from other parties?
Yes.
And with that information, along with your own research, did you create and cause to be filed with the commission direct pre-filed testimony? And along with that, 12 exhibits that are listed DPU exhibit number 3.0 direct through 3.12 direct?
Yes.
And did you also create and cause to be filed with the commission surrebuttal testimony with 3 exhibits that are DPU exhibit number 3.0 SR through 3.2 SR?
Yes.
And I'd like to correct the first question that I asked you. If there were 12 exhibits, with 3.0 being the first one, that would be 13 exhibits. Is that correct?
That is correct, yes.
If I were to ask you the same questions included in your direct and surrebuttal testimony, would your answers remain the same?
Yes.
And do you have any corrections that you would like to make?
Yeah, just a couple minor corrections, and it's in the direct testimony. It would be on line 490 and 491, which is page 26 of the direct testimony. There is a list there of some growth rates that was used in the analysis, and the Reuters should be struck from that because Reuters was not used. So on line 490, it says Reuters, and also line 493, and those should be struck from the testimony.
Thank you. With those corrections, I'd like to move to enter into the record of the hearing the direct and surrebuttal testimony of Mr. Coleman along with the attached exhibits.
If anyone objects to that motion, please indicate, Jimmy. I'm not seeing any objections, so the motion is granted.
Thank you. Mr. Coleman, have you prepared a brief summary of your testimony on this docket?
I have.
Please go ahead.
Thank you. Good morning again, Commissioners. My testimony reviewed generally accepted evaluation methods, including the capital asset pricing model, the constant growth discounted cash flow model, and the bond yield plus risk premium approach. These financial models provided a solid framework for an analysis to arrive at a cost of equity for Dominion Energy Utah. I have concluded that the appropriate cost of equity for Dominion Energy Utah is 9.25%. The current market conditions support a reasonable range for cost of equity between 8.09% and 9.55%. There are a number of factors that go into this recommendation. There has been a long-standing discussion dealing with the fair rate of return versus the cost of equity for utility companies. The 9.25% ROE balances the fair rate of return for investors while providing just and reasonable rates for captive utility customers.
Thank you. And I have no further questions. Mr. Coleman is available for cross and questions from the commission.
Okay, Mr. Moore or Mr. Snar, do you have any questions?
No questions, thank you.
Thank you. Major Kirk?
No questions, thank you.
Mr. Meekum? No questions, thank you. Mr. Russell?
No questions.
Ms. Clark or Mr. Saban?
We have no questions, thanks.
Commissioner White?
No questions, thank you.
Commissioner Clark?
Do you have an opinion regarding the capital structure recommendation of the company? Or proposal of the
Sure.
company?
I can tell you what I said in our testimony because we felt that it was a stipulated amount. We didn't look at it much. I would say from my own personal experience, though, that the capital structure does impact a potential return on equity because those two are tied together to ultimately come up with what the revenues requirement would be for a company. So there's been a lot of discussion here of what the appropriate capital structure would be. Our 9.25% was in consideration of a capital structure of the 55-45. And as we said in there, if there was some changes in the capital structure, then you may want to look at a rate of return that would reflect the amounts that would be appropriate with that. So that's, I don't know if 55, 60, 50 is the appropriate amount with that, 52. But I would just give some direction to the commission that obviously when you're setting those two elements, they do have an interplay that impacts customers as well as investors. I don't know if you wanted me to get more specific than that, or?
I understand what you're telling us, and thank you.
Okay.
Just one question about your Exhibit 3.02. Do you have that in front of you?
And that would be
It's an
indirect.
it looks like an S&P rate case history, past rate cases. Oh, yeah, I think it was to your surrebuttal.
Oh,
Yes,
okay.
to your
Surrebuttal.
surrebuttal.
Okay.
3.02 SR. Yes.
Yes, I have that.
You may not know the answer to this because it looks like you pulled this from S&P, correct?
Yes.
This was, okay. So this chart does not indicate what the pre-existing approved ROE was prior to these decision points. It has the requested and the approved, but not what the ROE was prior to the decision. Is that correct?
What I provided to you doesn't have that. The information that we pulled does have that information, but for space and limitations, I had to try to decide what may be the most important information. If the commission would like us to, though, we could go back and provide what the return on equities were or what the changes were, because I believe that information, actually, I guess I'm not accurate, because I've looked, let me restate this. There's a lot of different elements and information in that, but I don't, but I put in there what I believe was the most appropriate as far as return on equity, but I don't think that information provides what the previous ones were.
Okay. Thank you. That's the only question I have. Thank you for your testimony this morning.
Sure.
Mr. Jetter, anything else from the division?
No, the division has nothing further on its, I guess, live case. Thank you.
Okay, thank you. Mr. Moore?
The office calls Allison Anderson and asks that she be sworn.
Good morning, Ms. Anderson. Do you swear to tell the truth? I do. Thank you.
Could you state your name and occupation for the record?
I'm Allison Anderson, and I'm a utility analyst for the Office of Consumer Services.
In that capacity, have you reviewed the application of DEU in this matter and the various filings?
I have.
Did you prepare direct testimony filed on October 17, 2019?
I did.
Do you have any changes you'd like to make to that testimony now?
No.
If I asked you the questions in your direct testimony, will your answers be the same today?
They would.
Request to omit the direct testimony of Allison Anderson.
Okay, if anyone objects to the motion, please indicate to me. I'm not seeing any objection in the room, so the motion is granted.
Have you prepared a summary of your testimony?
I have.
Please proceed.
My testimony introduces the Office of Consumer Services witnesses and provides the office's policy on Dominion Energy Utah's proposed changes to the infrastructure replacement tracker mechanism. Witness Dan Lawton presents the office's recommended overall cost of capital of 6.958%, which includes a return on equity of 9.1%. Witness Donna Ramus presents the office's rate base and net operating income adjustments and provides the analysis behind the office's revenue requirement. In surrebuttal, the office is recommending a reduction in the company's revenue requirement of $11,468,230 based on the CET allowed revenue. As part of its original filing, DEU requested changes to the infrastructure replacement tracker. The company seeks to increase the annual expenditure level of the infrastructure tracker from $65 million adjusted for inflation to $80 million adjusted for inflation, and to change the treatment of annual budget variances. The annual expenditure level adjusted for inflation is projected to be $72.2 million in 2020. The office is concerned with the size and scope of the infrastructure tracker and the intent of the prudence review specified in the Commission's infrastructure tracker evaluation plan. The office requests that the Commission clarify the intent and timing of the prudence review of the infrastructure tracker investments, as well as continue to monitor the size and scope of the tracker going forward. The office opposes the proposed increase to the infrastructure tracker annual expenditure level, but does support the company's proposed treatment of spending variances. This concludes my summary.
Ms. Anderson is now available for cross and questions from the Commission.
Mr. Jetter, do you have any questions for Ms. Anderson?
I do not have any questions, Mr. Chairman. Thank you.
Thank you. Major Kirk?
No questions, sir.
Mr. Meekum?
No questions, thank you.
Mr. Russell?
No questions, thank you.
Ms. Clark?
No questions, thanks.
Commissioner White?
No questions, thank you.
Commissioner Clark?
No questions. Thank you.
And I don't either. Thank you for your testimony this morning.
Thank you.
Mr. Moore or Mr. Starr?
Yes, our next witness would be Ms. Donna Ramus.
Good morning, Ms. Ramus. Do you swear to tell the truth? I do. Thank you.
Could you please state your name for the record?
Donna Ramus.
And what is your usual employment?
I'm a regulatory consultant.
And have you been hired by the Office of Consumer Services to participate in this proceeding?
Yes, I have.
Did you prepare direct and surrebuttal testimony in connection with this proceeding?
Yes, I did.
And with those testimonies, did you also prepare exhibits associated with the submissions?
Yes.
And do you have any corrections you would like to make to any of those submissions?
I wouldn't call them corrections, but there were some modifications made on the stand yesterday by Mr. Felsenthal that impact some items in my direct and surrebuttal testimony. So I'd like to quickly go through where his statements impacted what was said in my testimony.
Would you do that, please?
Yes. The first would be that I'd like to address first, would be in my surrebuttal testimony, going to page 44, line 259. I'm sorry, page 44, line 959, I discuss that Mr. Felsenthal indicated that the commission approved $8.18 million of pension expense in the last rate case. And on this stand yesterday, he corrected that amount and said the amount should be $5,612,000. I haven't been able to verify the correction of that number because it goes back to the 2013 rate case, and I don't have those files with me, but I have no reason to dispute his correction. But then if you also turn to the next page, on page 45 of my surrebuttal testimony, there's a table at the top where I provide a comparison of the pension expense that the company contends are included in base rates from that 2013 docket to the amount of pension expense actually booked by the company. And I use that $8.18 million from Mr. Felsenthal's pre-filed rebuttal testimony, and that amount would change to $5.6 million. But even if that number's updated, it would still show that the amount collected or included in rates since the last rate case compared to the actual pension expense has been significantly greater. And then the next item pertains to my direct testimony. At page 43, lines 936 to 939, I state, I am not aware of the company including a deferred pension asset nor an accrued pension liability and rate base in prior rate cases over the long period over which the accrual basis of accounting has been in effect for pensions. Mr. Felsenthal indicated on the stand that in the 99 docket, that there were a pension asset was included in rate base. So I was able to go and confirm that, and I looked at that case, which was, let me get you the docket number. Yeah, it was a docket number 9905720. In that order that was issued on August 11th, 2000, I believe it's at page 25, this issue was addressed, and it was part of a stipulation in that case. It appears under Section D, stipulations of certain revenue requirement items, as item number 12. And the order specifically states that the division challenged inclusion of that prepaid pension asset and rate base in that case. So the order states, and I quote, "To reach stipulation, the division would support an adjustment to remove $233,680 from rate base." This is compared to the $2,399,941 the company requested. And it's very clear from reading that order that it was included as a result of a stipulation reached between the parties, not based on a commission decision that should in fact be included. And those are the extent of things that have come up that would have impacted my direct testimony and my rebuttal testimony.
With those corrections or adjustments, if I ask you all the same questions, would you provide all the same answers otherwise today?
Yes.
All right. I'd like to offer Ms. Ramos's exhibits into evidence. It would include her direct testimony filed on October 17th, along with exhibits 2.1D through 2.17D, as well as her surrebuttal testimony submitted on December 5th, including exhibits 2.1S through 2.7S. I'd like to offer those into evidence.
Okay, if anyone objects to that motion, please let me know. I'm not seeing any objection in the room, so the motion is granted.
Have you prepared a summary of your testimony for today?
Yes, I have. And before starting, I had left my water at the back, and it's a bit of a lengthy summary, so I would appreciate if I could have it up here. Thank you. Yes, I do have a summary.
Please proceed.
Good morning, Commissioners, Chairman. The facts and circumstances of this case show that Dominion Energy Utah's rate should be reduced and not increased. As indicated in my surrebuttal testimony, rates currently being collected based on the conservation enabling tariff allowed revenues should be reduced by at least $11,468,230. This reduction is based on the impacts of the adjustments recommended in my testimony, coupled with the impact of the rate of return on equity recommended by office witness Daniel Lawton in this case. If the commission agrees with my recommendation regarding the costs for outside legal fees incurred by the company for assistance in the 2018 LNG proceeding, then the reduction of approximately $11.5 million should be increased by the amount disclosed in my confidential testimony in this case. My surrebuttal testimony discusses several issues remaining in dispute in this proceeding. As Mr. Stephenson indicated agreement with the reduction for the audit fee accruals, 7 issues discussed in my surrebuttal testimony remain in dispute at this time. I will briefly summarize my position on each of these outstanding issues in the order in which they appear in my surrebuttal testimony. The first area is the area of projected capital expenditures. The company's calculation of the projected test year plant and service balances assumes a substantial increase in the annual level of capital expenditures, increasing from a 2018 base year level of $212.2 million to forecasted amounts of approximately $232 million for 2019 and $277.7 million for 2020. The company has failed to provide a reasonable level of support or justification in its submissions in this case for these substantial increases in annual capital expenditures. The burden of proof in supporting its case resides with the company, and it's my opinion that the company failed to meet this burden in this case. When an itemization of the forecasted 2020 capital expenditures was finally provided with the company's rebuttal filing, the amounts provided in the rebuttal filing by functional category of costs differed substantially from the amounts previously provided in response to discovery and in the original filing. While the company did provide some additional information in response to discovery on some of the areas of capital costs and on a few of the projects, the amounts contained in the itemized listing finally provided with the rebuttal filing differed from what was previously disclosed for many of those costs. In fact, the cost change between what had been previously disclosed in this case and what was listed in the company's rebuttal filing had changed for all 21 of the functional categories of plant costs identified by the company. These changes, many of which were significant and you can quickly see the variances when you review my testimony at page 9, my surrebuttal testimony. It shows a comparison of what was identified by functional category of costs in response to discovery compared to what was ultimately provided at the late rebuttal phase in this case. It's my opinion that the company has provided too little information too late to support the substantial budget increase in annual capital expenditures for 2020. In my testimony, I recommended that those forecasted 2020 capital expenditures be reduced by approximately $43 million. Since the company's filing assumes a portion of the 2020 capital expenditures will remain in construction work in progress at the end of the future test year, coupled with the fact that we have an average test year being used, the removal of $43 million of forecasted capital expenditures reduces the average test year plant and service by approximately $13.4 million. The next area is the transponder retirements. As the Commission is likely aware, the company has experienced multiple problems with transponders that were manufactured by Elster that caused the early retirement or early replacement of those transponders from what was originally projected. This replacement program began in 2015 and is projected to be completed in 2020. As pointed out in my direct answer rebuttal testimonies, DEU has acknowledged several problems with its accounting for the dismantlement and the retirement of the L-Star transponders on its books. As a result of these accounting issues, the dismantlement costs associated with the removal of the L-Star transponders is effectively double counted in the company's filing. It's included both in plant and service in account 101 and again as a reduction to accumulated depreciation in account 108. As the company was replacing the transponders, it was booking the costs associated with dismantling the old Elster transponders as a part of the cost of the new replacement transponders. That's how they got included in plant and service in this case. Additionally, the method used by the company in its rate case model for estimating the dismantlement costs in its filing essentially picks up these dismantlement costs a second time through a reduction of accumulated depreciation, which also increases rate base. The company agreed in response to discovery that there was a double counting of the transponder dismantling costs in this case. I recommended that rate base be reduced by $3.6 million, which would remove the double counting of these costs. I also recommend that depreciation expense be reduced by $166,263 to remove the inappropriate depreciation that was applied to the dismantling costs for those replaced transponders. This still remains my position today with regards to this issue. This issue, I would say, has been pretty messy at times in this case because of the accounting errors and problems coupled with the double counting in the filing. In the information I've received throughout this case pointed out additional problems beyond what I realized at the time I filed my original testimony. As I sit here today, based on all the new information that's been provided by the company, I would likely have an even bigger adjustment than this I would recommend, but I think the adjustment recommended in my original testimony is still a reasonable means to take care of this problem and to avoid that double accounting in this case of those dismantlement costs. The next area regards cash working capital. Well, the company has agreed to substantially reduce the net lag days using in calculating its cash working capital requirements. One issue still remains in dispute, in my opinion. The revised lag days adopted in the company's rebuttal testimony still includes the impact of depreciation and deferred income taxes in the determination of the net lead lag days. As explained in my testimony, it has been long-standing commission policy that depreciation be excluded from the determination of cash working capital. And within my direct testimony, and possibly my rebuttal as well, I quote from a prior commission decision that specifically addresses that long-standing precedent and sets some bars that companies are required to bring into to address the issue fully for the commission prior to changing that policy, and the company hasn't done that in this case. If the impacts of the deferred income taxes and depreciation are removed from the lead lag study adopted by the company in its rebuttal filing, the negative 0.828 lag days that was agreed to in rebuttal would be reduced to negative 0.905 lag days. And again, I acknowledge that that's lower in lag days than the number presented in my testimony. However, the company adopted the division's position on that issue. And if you're going to adopt that position, then you still need to look at that depreciation expense issue. The next area is inflation. In its filing, the company inflated the 2018 base year non-labor expenses by FERC account using inflation factors provided by Global Insight Power Planner report. While the use of inflation in forecasting a future test year may be appropriate in some circumstances, it shouldn't just be an automatic given in a case. Rather, the facts and circumstances for the specific company at the time of the case should be evaluated. The reality is that the company has been quite successful in reducing its O&M expenses in recent years. This reduction has continued even into this year, into 2019. As background, energy efficiency program costs are not collected in distribution base rates. So once non-recurring employee severance payments and the energy efficiency program costs are removed from the operations and maintenance expenses, the amount of operations and maintenance expenses incurred by the company in the first 6 months of 2019 were actually 1.65% lower than the O&M costs excluding those efficiency programs for the first 6 months of 2018. Given the reduction in O&M expenses and the continued reduction occurring after the base year, which would be the 2018 time period, I recommend that those base year non-labor O&M costs not be inflated in this case. Removal of the inflation factors from the company's rate case model reduces revenue requirements by approximately $1.9 million. And again, the exact impact would be dependent on other adjustments made by the commission in the model because they flow automatically through the model. The next area where there's a difference between myself and the company at this point would be with regards to the excess deferred income tax amortization. And I believe there's really only one issue remaining in dispute with this that impacts the revenue requirements in this proceeding. It remains for the commission to decide the appropriate time frame over which to return the non-plant related excess deferred income taxes to Utah ratepayers. The parties are in agreement on the amount, which is approximately $14.56 million, inclusive of the associated tax gross up. I'm recommending that this amount, which is a small portion of the total excess deferred income taxes owed to ratepayers, be returned to ratepayers over a 5-year period. And that's in large part due to considerations of factors such as interjurisdictional equity issues and the fact that the plant-related excess deferred income taxes are being flowed back over an extremely lengthy period as is necessary under IRS rules. So as explained in my testimony, I recommend that at least for this item that's a small portion of the total amount owed to customers, that be done on a quicker basis than what the company has proposed. The next area is the costs associated with the LNG facility proceedings. I recommend that the outside legal costs incurred by the company and charged to base year expenses for assistance in seeking approval of its decision to construct the LNG facility be removed from the test year. These legal costs associated with the 2018 proceeding are not reflective of ongoing regulatory costs that would be incurred by the company on an annual basis. And I know some questions have been asked earlier in this proceeding regarding those costs. With my direct testimony on OCS Exhibit 2.17D, which is confidential, that provides the company's response to OCS 1.14 in this proceeding, which provides a breakdown of the outside legal fees that are included in the base year by matter. My adjustment removes only a portion of these fees that would be applicable to those LNG proceeding costs. And if the commission would like at some point while I'm on the stand for me to point out which lines of that exhibit specifically I removed in coming up with the amount on the confidential adjustment I have, I believe I can do that in a public way by walking through that exhibit without being too specific. But by looking at that exhibit 2.17D, that confidential exhibit, you could see that if my adjustment was made, which the amount of which is provided in my confidential section of my testimony, you could see what types of other costs would still remain in the test year for legal fees in the adjusted test year, if my adjustment's adopted. Okay, and then the final issue I wish to address is whether or not pension expense should continue to be incorporated in rates in Utah for this company based on the accrual basis of accounting. This, at least in my opinion, is perhaps one of the, if not the most important issue in the areas I'm addressing in this proceeding. as the Commission's ultimate decision on this issue could have very long-term consequences and rate impacts on Utah ratepayers for many years to come. For financial reporting purposes, the accrual basis of accounting has been required for pensions since 1987. So for over 30 years, they've been accounted for on the company's books and records on that accrual basis of accounting. And to the best of my knowledge, it's also been incorporated in Utah in base rate cases that have occurred since that 1987 timeframe on the accrual basis as well. And under that, if there were years in which actual cash contributions to the pension plan would have been zero, or years in which the actual cash contribution may have been lower than the expense amount determined under the accrual basis of accounting, the amount incorporated in base rates during the rate cases would have been based on that accrual accounting basis, regardless of what the cash outflow would have been. Under the accrual basis of accounting for pensions, negative pension expense can occur, and it does occur. The negative pension expense, which could be referred to as pension income or pension credit, I've heard various terminology used for that, but regardless of the terminology used, the fact remains that negative expense or a pension credit can result under accrual accounting. The company has, in fact, been recording negative pension expense on its books for several years and anticipates to continue that into the test year. In fact, the table I discussed earlier where I discussed the impacts of Mr. Feltensaw's change on my table clearly shows that there's been negative pension expense booked for several years now. Now that the result of accrual accounting has resulted in a negative pension expense or credit amount, the company wants to abandon the accrual method of accounting for pensions and determining its revenue requirement instead wants to include zero pension costs and rates. It's my opinion this is both unreasonable and unfair to ratepayers. As an alternative, which I understand this isn't the company's primary position, but Mr. Felsenthal offered the alternative company position that if the negative pension expense is included in rates, then it should also be allowed to include a prepaid pension asset on its books in rate base. I disagree for many reasons. They're expressed both in my direct and rebuttal testimonies. In fact, I find the company's attempt to exclude the negative pension expense from revenue requirements and its alternative recommendation to increase rate base substantially for a prepaid pension asset to be particularly alarming in this specific case. As the Commission is well aware, the company recently merged with Dominion Energy Incorporated. And under the settlement and stipulation in that merger docket, which was approved by this Commission, Dominion Energy agreed to contribute $75 million in funding to Questar Corporation's retirement plans. That settlement stipulation specified that this contribution was to be made by Dominion as a, quote, shareholder's cost, end quote. To the best of my knowledge, there was no indication in that merger proceeding that the company would attempt to include that shareholder contribution in rate base, or that it would attempt to seek to earn a return on that contribution amount. In fact, the testimonies filed by the joint applicants in the merger proceedings indicated that the $75 million contribution to the plan assets would translate directly to a reduction in pension costs borne by customers. In presenting the estimated benefits to customers from the contribution, the joint applicants did not offset the cost savings that they had presented in that case to include a shareholder return on that $75 million contribution. In fact, had it done so, the net impact would have likely showed an increase in revenue requirements to customers as a result of that, and not a reduction in costs. And part of the reason for that is you're applying a rate of return on that amount, which includes a higher equity return than the interest rate used in determining pension expense, as well as a tax gross up for that equity return. As explained in my testimony, the test year pension expense would have been negative or a credit amount even without that $75 million contribution. By removing the negative pension expense in this case, the company's clearly removing the benefit to ratepayers of the contribution that was asserted by the joint applicants in the merger proceeding. On this important issue, I continue to recommend that the negative pension expense of approximately $5.4 million on a total Dominion Energy Utah basis be included in the adjusted test year, and that the prepaid pension asset be excluded from rate base. Thank you.
Thank you, Ms. Ramos. Before we conclude and turn you over for cross-examination, I'd like to direct your attention to the Dominion hearing exhibit number 8 that was presented this morning. Do you have that in front of you?
Yes, I do.
Now, recognizing that there was a correction made in footnote 1 to show $4 million instead of $5 million, with that correction, does this exhibit resolve the accounting issues that you have identified in your testimony?
No, I don't agree that it does. As indicated in my summary, I still recommend that the adjustment presented in my direct testimony be reflected. As explained, there have been numerous problems with the company's accounting for the Ulster transponders from, for example, the date they retired the transponders on its books and records, and the fact that the dismantling costs were booked to plant and service as part of the new transponders, in the double counting and the filing. I had presented direct testimony pointing out several of these issues, and yet the company in its rebuttal filing still argued that no adjustment should be made for this. And so then in my rebuttal, I addressed it again and pointed out the fact that there is a double counting of these costs. This exhibit, I mean, now the company's coming in and adjusting the timing, application equip, in a lot of different adjustments that would need to be made to the rate case model if this revised approach is considered. But even that, even if that were to be accepted, which I don't recommend be done, there is the error for the 2020 amount, or at least the fact it's inconsistent with what's contained in Mr. Stephenson's Exhibit 3.2R for 2020. But you also have the fact that there is, according to Mr. Stephenson's Exhibit 3.2R, there's also $3.7 million of plant and service that was booked to plant and service associated with the dismantlement costs of the Ulster transponders that were replaced from 2016 through 2018. Those are still in that plant and service balance, even with this revised calculation that was presented by the company today. So I continue to recommend that as a way to resolve this issue, that the adjustment in my direct testimony be adopted. The commission has how to flow that through the rate case model in the record, as well as, I believe, my adjusted rate case model was also submitted with my testimony. So that's all information the commission should have available to do that. And again, as I indicated, this new information presented regarding the timing of QIP and the which accounts should or shouldn't have that QIP timing issue applied has come so late in the record that I don't recommend this approach be used. And again, as I indicated, if I'd had this information sooner before I filed my rebuttal testimony, I suspect my adjustment would have been even higher than what I'm recommending in this case.
Thank you. Ms. Ramos is available for cross-examination.
I think at this point we'll take a break and return to start the cross-examination of Ms. Ramos. So why don't we break until 1:30, and then we'll reconvene at that point. Thank you. I think we're ready for cross-examination of Ms. Ramos, right? So, Mr. Jetter, do you have any questions for her?
I have no questions. Thank you.
Okay. Major Kirk, do you have any questions?
No question, sir.
Mr. Meekum?
I have no questions, thank you.
Mr. Russell?
Questions, thank you.
Ms. Clark or Mr. Saban?
In the words of Sesame Street, which one of these things is not like the other? Good afternoon, Ms. Ramos.
Good afternoon.
I want to focus first on the plant, your objections to the capital budget for plant for the 2020, for the revenue requirement portion that is associated with that. I want to just get a few things in the record on that point. It's true, isn't it, that the division requested in a specific line-by-line itemization, I should say, of each of the projects that are included in that capital budget, and that was requested back in September.
I don't know if the division did, but the OCS, let me see who submitted the data request. It's in my response. If you give me just a moment.
No problem. Are you referring to your surrebuttal?
No, this would have, I believe this was filed with my direct.
For your reference, if you looked at DPU 7.04, which is attached to your surrebuttal, it's included in the Exhibit 2.7S, and it's page 1.
Oh, yes, this wasn't a request. You had asked about an itemization of projects, and the office had asked for an itemization before September. And in a September, I believe it was September 5th response, the itemization was not provided. What you're referring to, this DPU 7.04, the DPU had asked for a breakdown of the capital expenditures by category consistent with the categories in the merger integration report. So it didn't ask for individual projects per se.
Here's my question. As of September, the company provided an itemization of all of the capital projects that are included in your surrebuttal table.
It didn't provide an itemization of the projects. It provided a breakdown of costs by category, but an itemization of the actual projects included within those categories wasn't provided till the company's rebuttal filing in this case.
Okay.
So maybe it's just the language. I agree the company provided a grouping of project costs, but not individual projects for all the projects.
Did you send a data request asking for an itemization prior to that?
Yes, I did. If you give me a moment, I thought it was included.
I'm still going to refer you back to 7.04, that page 1. The second page of that exhibit has a listing of the items and amounts that add up to $277 million by category.
Yes, we had asked, and again, it's included in my direct testimony as an attachment where we asked a data request asking for the budget, including the filing, in the most detailed level available. But if I can, so you would like me to refer to
Can you just
the
confirm
response to
for me
704?
that if you looked at page 2 of data response to 7.04, you had that information as of September 3rd, 2019?
Well, not by project. We have it by category of plant costs. We had it by that date.
Right, and you had the total and each of the amounts for each of the categories.
The amount by category, but
Right.
not by project, correct?
Right. Okay. And you agree with me that that was subsequently updated by the company when it did its 2020 budget?
Yeah, I've seen this number update. This specific format updated 3 times in this proceeding. So I believe the third time would have been when they provided the rebuttal testimony.
Okay, do you have any problem with the fact that the company updated it to provide you with additional information as it came available?
No, I would have appreciated a detailed listing much earlier in the case. We had sought the detail, and in my view, there wasn't a level of detail provided beyond high level by category and a few specific projects identified by that point. The format the company provided in the rebuttal exhibit, I think, is very helpful, and it would have been nice, I guess, if in an earlier phase the company had provided the detail it had at previous stages. I mean, I understand capital costs can shift between category and project, but just the fact that this level of detail wasn't provided till the level of deal by project, not by category, but by project, wasn't provided until the rebuttal phase. And the fact that, I mean, as pointed out in my testimony, there are significant shifts in the cost from what was originally provided, not just minor, but fairly significant in my view.
We'll come to that. Suffice it to say that at this point, you believe the information provided does outline by item the amounts that the company anticipates based on its budgeting, what will be spent for each project?
Yes, the exhibit provided in the rebuttal testimony provides the current estimate by project.
Okay, now subject to check, the information provided in the company's direct testimony, as supplemented later by data responses and rebuttal testimony, is the same kind of information the company has relied on for years in its rate cases. Isn't that right? It has always provided a listing with a number, with the same kind of detail that we're dealing with here.
Yeah, I can't speak to this. The last litigated rate case I didn't participate in, that was the 13 docket. I had begun my review of the last rate case that ended up being settled as part of the merger proceeding. And as I sit here today, I don't recall the level of detail. But if all that was provided was a list like what's on this page 2, very high level, I anticipate if the case had gone on, I would have asked for quite a bit more detail, particularly if there's a large increase compared to historic budget levels.
But you have no basis to say that the company's disclosures of this kind of information in this kind of format has ever failed to satisfy the burden the company has, that you noted in your statement, of identifying what its capital budget is based upon.
Yeah, I can't speak to past cases, but again, in this case, we're looking at a significant increase in the annual budget level. So in my view, there should be a higher threshold set to justify and support a significant increase in capital costs compared to the historic what's happened.
You think the burden of proof should change because there's a different number?
Well, the company still has the burden of proof to support its case.
Understood. I just want to make sure we're clear. Your position is that there should be a heightened type of burden in this case?
Perhaps not heightened, but as an analyst that reviews revenue requirements in many, many cases, when you have a large increase beyond what had been done historically, I would anticipate a much higher level of support and information being provided by the company to support that increase.
That's just based on your opinion then?
It's based on my opinion, having done this, I think, 28 years now.
Okay. I want to switch over just to the projects themselves. I want to be clear. My understanding is you don't object to any of the projects. You don't say that they're imprudent or that they should be excluded or that they shouldn't be completed by the company.
No, I did not.
Okay. And you've heard testimony and you've seen data responses showing that the company over the last 5 years has been within 1% of its budget. Its spend has been within 1% of its budget in every one of those years. Isn't that right?
Yes, that's my recollection.
Okay. So the company, wouldn't you agree, has a pretty good track record of meeting its budgets as it relates to its capital expenditures?
In total dollar amount, they have historically. I can't speak if that is still the case going forward, but historically, yes, they have.
And isn't that really, at the end of the day, what we should all be, what you should be concerned about is what the customers are ultimately spending, not what any particular project costs? In other words, let me rephrase. If the company says we're going to spend $277 million, and that's what the commission sets rates on, and customers end up spending, or end up being charged in all, the equivalent of $277 million approximately, then the customers are not made worse off by that. Isn't that
I'd like to
right?
object to the question. It's asking this witness to opine on what this commission should do in a form and format different than carrying the burden of proof, which goes with the filing of the application. I object to it.
Do you want to respond to the objection?
Sure. She's challenging the $277 million amount, claiming that somehow that is unreliable, or that is an improper basis, and that customers could somehow be hurt from that. That's what her testimony says. I'm just trying to help her elaborate for me how the customers would be hurt if we're on budget.
I continue the objection.
Sure. I'm going to take a moment and think about this one. Yeah, I see the question as relevant to her testimony. I can't, I don't think I can rule that it's not relevant to the testimony she's already provided, so I'm going to allow the question to be answered.
Okay, I didn't say customers would be hurt by it. Parties outside the company have not had an opportunity to scrutinize the individual projects that result in this very large increase of projected capital expenditures. I don't believe that it's appropriate for the company to just say, well, what if the company had said $400 million? We're going to spend $400 million this year. Does that mean that it's not appropriate for the regulators and interveners to be able to look at what makes up that $400 million to decide, is that prudent? Is it appropriate to include in the future test year? And is it likely that they're going to spend that much in the future test year? Because again, we're dealing with a future test year, not a historic test year here. I don't believe my testimony ever said customers are harmed by that $277 million of expenditures. I didn't have the opportunity to look at those projects on an individual basis for the total until the company filed its rebuttal filing in this case.
Let me break that down. And I wasn't saying customers were hurt by the number. I was saying that my understanding from your testimony was you were saying that the substantial increase, which you didn't think was justifiable, was excessive, and customers shouldn't have to pay for that. That's how I understood it.
Yeah, I said, I didn't say it wasn't justified, just that the company had not justified it and provided a reasonable level of support for it.
Okay, so let me try and be brief about this. The office and the division have participated in IRP proceedings. They've participated in just about every proceeding this company has filed, many of which deal with these very projects. Isn't that right?
Yes, they do, and I do know at least a few of the projects included in the listing that was provided have been discussed and addressed in the IRP proceedings.
So it's not accurate for you to say that other parties other than the company have not had the opportunity to scrutinize these projects. It's not true, is it?
For some of the specific projects, yes, but again, from what was provided in the initial filing, by cost category, changed in the company's response to discovery requests, and then changed again substantially, again, not in total, but by cost category when the company filed its rebuttal. So it's hard as an analyst to sit down and evaluate the reasonableness and appropriateness of those costs when we didn't get the details behind those costs until much later.
You served data requests, or the office did, asking about individual projects. Isn't that true?
I asked for the budget in the most detailed format available, and that wasn't provided to me.
Well, I should be more...
Maybe if you can reference a specific data request.
I should be more clear. Not necessarily you. The office served data requests asking about specific projects that it had questions regarding in this proceeding. Isn't that right? It asked for detail about them, about what they were all about how the company was coming to its numbers.
By individual projects, if you could point me to a specific data request. Again, I didn't have the list of individual projects until the rebuttal phase. And I wrote a lot of data requests in this case, so I may have and just don't specifically recall it.
Sure. May I approach?
Yes.
This is 10 and 11, and I haven't written the pre-marked numbers. 11 and 12, excuse me. So 11 will be the OCS 10.04. And, sorry, did you say 12, 11 and 12? 11 and 12. So 12 will be the 10.03. Do it this way. This first. So this one is number 11. And this one is number 12. Pencil. 12.
Okay.
Everybody? Okay.
Yes, while you were handing this out, I was able to open up my plant and service folder, and I do see these responses in there. And I believe I did write these questions.
So these were specific, it's true, isn't it, that these exhibits 11 and DEU hearing exhibits 11 and 12, they were from the OCS, and they were asking specific detailed questions about specific projects, right?
Yeah, Exhibit 11 asked specifically about the Southern System Expansion Project.
Mm-hmm.
Yeah, and then OCS 1.03 references another data request and asks for more plan information.
Right, and the company, in fact, did provide responsive information to those requests, isn't that right?
Are you referencing 12, the one DPU, the references DPU 10.3, 10.4, 10.6, and 10.7?
I'm referencing, let's start with 11, DEU hearing exhibit 11, answered the question you asked, right?
Yes.
And by the way, I should note for the record, Commissioners, that there were attachments to these. They were voluminous, and we didn't think that it pertained necessarily to, we don't want to dump a bunch more paper on people unnecessarily. So anyway, this is just the cover page of those two responses. And so that's right. The company responded in 11 to a question you asked and provided additional information, right?
Yes, on the Southern System Expansion Project, yes, it did.
And there wasn't any follow-up saying that what we provided was not adequate for what you needed. That's right, isn't it?
No, it's not. And again, I don't challenge any specific projects the company's included. And I don't take issue with the Southern System Expansion Project.
I appreciate that. I just want to make sure the company provided this information, and to my knowledge, and subject to check, I don't think we ever heard from you or the office saying that they were deficient responses.
Yes, these data requests references the company's rebuttal testimony, which is when it provided the listing of projects. And they're responsive to the questions asked in the data request.
Right. Okay. And so to the extent you wanted to follow up on any specific project, you had the opportunity, and you did in fact follow up on them, and there was in fact a response.
Specific to the Southern System Expansion Project, yes.
Well, Exhibit 12, they cited you to 4 other discovery responses where the information you had asked about was provided.
Yes, and I didn't submit follow-up on that.
Right. Okay. Are you aware of any of these requests that you sent that the company didn't, where you ask about specific projects where the company didn't respond?
No, I'm not. But again, these data requests were asked after the company's rebuttal filing was provided, because we had requested more detailed information well in advance of when my direct testimony was due, and the company hadn't provided that information until its rebuttal filing. So in my direct testimony, I wouldn't have had the opportunity to address the specific projects.
Right, you would have been in your surrebuttal though, right? That's why you, I assume
To
that's
the
why you
extent
asked.
in that very limited amount of time between the filing of the company's rebuttal and our surrebuttal, I didn't have time to do a detailed review and analysis of those projects. They constitute over 300 projects, I believe.
Okay. Now, I want to move on because I want to keep us moving here. So you don't, because you don't object to the specific projects, then I take it that the amount itself associated with those particular projects, you don't have any basis to challenge the amounts associated with each of the projects or the global amount itself. In other words, you don't know that you're not saying that's incorrect?
No, I'm not saying it's incorrect. It would have been nice to have the information much earlier in the case when requested so that a more thorough analysis could have been conducted of it. But I don't have a basis as I sit here to challenge any specific project.
Okay, or its amount, right?
No, I noted in my surrebuttal that the amounts have changed substantially for some of the individual projects. I haven't had a chance to follow through on what's driving those significant changes, but I don't challenge the dollar amounts. I have no information with which to really analyze those amounts and challenge them.
And you're not suggesting that there's anything improper in what the company has done, in other words, that the numbers are not its best information, most accurate information today is what is provided?
Yeah, again, the substantial changes, I hope that's the best and most accurate information. I do take issue with the manner in which it was provided and the lateness of it and the prior budget detail not being provided.
Okay, thank you. The difference you're noting between between the 2019 budget, or the 2019 capital expenditure amount and the 2020 and forecasted amount you highlighted is about $45 million. Is that right?
I seem to recall 43 million, but somewhere in that range. Yeah.
You might be right. You've been in testimony. You've heard the testimony in these proceedings up to this point, right?
Yes, I have.
And you've heard the company's witnesses identify that $43 million difference is largely, if not entirely, made up through a $10 million proposed tracker increase, a $19 million southern expansion, and a $14 million Kern River gate station being built up in northern Utah. You recall that?
Yes, but as Mr. Orton pointed out earlier today, I don't know if that's the entire cause of the difference, because in 2018 and 2019, you had completely different projects for all, the itemized listing of projects is different. Yes, there's that amount in the 277.7 million for 2020 for those three projects.
You think all of the projects on 19 are different than all of the ones on 20?
No, you'll have some, so we say blanket type projects that you do for year. You'll have feeder line projects you do, some of them would be blanket type projects that occur year to year, but some would pertain to specific projects in that year.
Okay. So I think if, at the end of this, if I understand your testimony correctly, your objection is primarily that you didn't feel like you got enough information early enough along in this process. That's your primary objection?
Yeah, it's my view the company didn't provide us the information early enough to do a more thorough analysis of this substantial annual increase in capital expenditures.
Okay, not with the underlying substance or the amounts that the company has provided?
No, again, I was unable to really do a deep analysis of the underlying amounts in that.
Okay, thank you. I'm going to move on to inflation now. A couple questions about inflation. You noted in your summary that the company had reduced costs in the years since the merger. At least that's my understanding of what your statement said. Is that right?
Yes, O&M expenses have declined.
Yeah, and that was in fact something that the company represented would happen as a result of the merger. Isn't that right?
That's my understanding, yes.
Okay, so even if that were true, which it is, though that is true, it's also true that that doesn't mean that inflation isn't still affecting the company's costs. Isn't that right?
Yeah.
If the company's saving money, that doesn't mean that they've reversed inflation, right?
No, it would mean there were productivities and other cost savings that more than offset the impacts of inflation on costs.
Right, and you don't submit any evidence in your testimony that inflation has not caused non-labor O&M costs to increase since the last rate case?
No, because presumably inflation still impacts the company's spending. It's just that productivities and other cost savings have more than offset that inflation.
Right. In that respect, wouldn't you agree the company ought to be applauded that it has made efforts to save customers money?
Oh, yes, I think I pointed out in my testimony that, yes, that is a very good thing that they've been able to do.
Okay. And the global insight factors, the ones the company used that are assigned to each FERC account, those have reflected that inflation is in fact, they've accounted for inflation and have reflected that inflation is in fact impacting those non-labor O&M expense items, right?
Well, yeah, those are estimates by FERC account of the inflationary impacts by account.
But but those global insight factors, the point is, they show that inflation, that they're accounting for inflation or representing that inflation is in fact taking place in those categories, right?
Yes.
Okay. And in that respect, the company has complied and followed the prior precedent that's been used in prior proceedings by including inflation in its revenue requirement. Isn't that right?
Yes, it has.
Okay. And so what you're proposing to eliminate inflation would be the break with precedent, not what the company is proposing here.
Again, it is discussed in my opening summary and in my testimony. It should be looked at in a case-by-case basis. It shouldn't just be automatically applied. At the time I wrote my direct testimony, the company's budgets reflected significant reductions of O&M costs below what was experienced in 2018. And in those circumstances, coupled with the regular declines in O&M expenses that the company has been able to achieve, which is wonderful, I didn't view that the company had demonstrated that its overall O&M expenses are likely to increase consistent with inflation factors. That's a long answer, but hopefully it was responsive to what you're asking.
Kind of. I mean, as I read your testimony, you don't provide any evidence that inflationary factors are not continuing to impact the company's non-labor costs.
No, I don't.
So to the extent they are, don't you agree with me, the company ought to recover them because they're costs the company will actually have to pay?
They may or may not actually have to pay it because, again, you're looking at overall O&M expenses, and there are a lot of other items and factors that impact those expenses.
And subject to check, it's true the company has under-earned since the last rate case. Isn't that right?
That's what the company contends.
You have any basis to dispute that?
No, but again, they were in a stay-out agreement as part of the merger stipulation, is my understanding. So the extent to which inflation may or may not have caused that, I wouldn't agree that any under-earnings that they may or may not have had was caused by inflation because the company itself presented numbers showing that the O&M expenses have been declining, not increasing during that period.
The stay-out wouldn't have been applicable until after the stipulation in the merger, right? So 14, 15, 16, right? That wouldn't have impacted that.
Yeah, and to be honest, as I say here today, I don't know what your earnings were in those years.
Okay, last subject, I want to talk about your very favorite topic, the pension account. I'm sure everybody, we can hear the collective groan. But as you say, it's an issue that needs to be addressed in this proceeding. So I think if I understood you correctly earlier today, you said that as of 1999, the asset balance in the pension trust was $2.3 million. Is that right?
That's the amount that was provided by the company in response to a data request.
I guess I want to know, do we have any disagreement on that number?
Not on that number, no.
Okay. And so you sent a data request to the company asking the company to provide the balance in the pension account from that date, from the earliest date it could, and it provided it from 1999 forward at least.
It did not provide the amount of prepaid pension asset or potential pension liability for any of those historic periods beyond the 1999 year in the rate case. I did ask for the amount of prepaid pension asset or pension liability on the company's books as of December 31st for historic years as far as the company had, and that wasn't provided to me. The only number provided to me with regard to the prepaid pension asset was the amount from that 1999 rate case.
Well, I guess I want to make clear. So I agree with you that you didn't have information that went back all the way to where you requested, that some of that information was not available. But as of 1999 forward, you were provided, were you not, with the pension expense in each year in that since 1999, as well as the balance in the trust account, the contribution amount, the contribution total that was in that account.
I was provided the amount of pension expense and the amount of cash contribution to the account, but I wasn't provided what the prepaid pension liability or the prepaid pension asset, or what the pension liability or prepaid pension asset on the company's books was in each of those years, and I had asked for that.
So the company, though, provided you that in 1999 that the prepaid pension account total was 2.3 million, right?
Yes.
Okay. So I want you to have that number in mind as we go throughout our questioning on this point, okay? Isn't it true that since that 1999, from 1999 forward, and with the exception of 2 years, in every year since that time, the contribution provided by shareholders has exceeded the amount of expense that the customers have had to pay?
Again, as discussed in my testimony, I don't agree that necessarily that has been provided by shareholders. As explained in my testimony, there is no tracker here in Utah that shall we say, tracks pension expense and rates compared to pension expense that's booked on the company's books. It's my opinion that you can't conclude if it's ratepayers or shareholders that are funding that amount without all the information needed to make that determination.
Would you open up to your, it's OCS 11.5, and it's attached to your surrebuttal as, it's page 20 and 21 of your surrebuttal is the data response that was provided by the company on that question. Tell me when you get there. It's your exhibit.
2.7S, perhaps?
Yes.
And that's page 20 and 21?
20 and 21. Do you see that data request, 11.04, and then 11.05? Excuse me, 11.05.
Yes, I have that.
Okay. And the second page of that response provides, from 1998 forward, it provides the contribution amount, and it also provides the pre-cap expense, or the customer, that would be the expense in each year for the pension account, right?
The pre-cap, so by pre-cap expense, is that
Let me represent
the total net periodic benefit cost before a portion of it's removed for capitalization?
Let me represent to you, my understanding is that is the annual expense amount to pay all of the pension costs in that year.
I just want to make sure I'm getting the right number, because terminology with pensions is very, very tricky. I want to make sure I'm agreeing to, and I'm not saying I disagree with you, I just want to make sure that you're understanding what this is and my understanding based on reading the responses, so just give me a moment.
Sure, absolutely, take your time.
Okay, yeah, I see here, this would be the total net periodic pension cost before application of the capitalization factor. So it wouldn't necessarily be what hits expense on the company's books, but it would be the pension costs recorded on the company's books. Maybe if I can explain.
I would sure love that, because I don't understand what you just said.
You go through the outside actuarial firm will go through all the pension plan calculations, And as a result of those calculations, you come up with a net periodic benefit cost. Sometimes people refer that as the pension expense, but it's the total annual cost. And then when the company books that cost on its books, a portion of that is expensed, and a portion of that would go to capital. So say the capital projects that are added to construction work in progress during the year. And according to the first page of that data response, which is on page 20 of that exhibit, it indicates that between 50 and 70% of the pension cost has been expensed. So you would take each of these amounts on this exhibit and
Part of it would be.
apply a factor, that factor of anywhere from 50 to 70%, and then that would result in the amount of expense recorded on the company's books in that
Well, the
year.
expense would actually be lower in your explanation, right? That's booked on the company's.
Yeah, the amount booked it'll all be booked on the company's
Sure.
records, but the amount that's booked to expense would be lower.
And my point to you is that if we compare the columns, there's a column called contribution and there's a column called pre-cap expense, right?
Correct.
The column on contribution, with the exception of 1998 and 2000, and every other year except those 2 years until you get to 2016, I'll come to that one in a moment, the contribution portion has exceeded the expense, and in most years, substantially exceeded the expense total in each of those years.
Well, I wouldn't say in most years substantially exceeded, but once you hit the
Let's just
mid-2000s.
let's start with, it exceeded.
Yeah, the amount contributed to the plan exceeded the amount of net periodic benefit cost.
Okay, and then starting in the 2011 period, it's substantial, would you agree with me that it substantially exceeds it? From that
Yes,
point forward?
I would agree that the amount of cash contributions to the pension plan exceeded the cost by quite a bit.
Okay, now, do you have any evidence that customers paid any portion of that excess contribution amount over and above what expenses were?
I would need an extra column to make that determination. I would want to know the amount included in revenue requirement in the rate cases that occurred during this time frame, to then compare the amount of contribution to the amount in rates to determine if it was funded by customers or shareholders.
And you had that information available to you when you prepared your surrebuttal testimony, isn't that right? When you created your chart that you referred to in your summary earlier, where you've gone from 2014 forward, you actually had all the information you needed at your disposal to go back to 1999 and actually calculate, if you wanted to, how much of that had been funded by shareholders and how much of that had been funded by
I seem to
rates.
recall I wrote data requests to try to obtain the information to do that, and I didn't receive all the information I would have needed to do so.
You just told me you would have had to know what was in customer rates on those, right? That would have been available to you by looking at rate case, any rate case information over that time period?
No, and here's why. If you go back a couple more pages to page 22 of that same exhibit, we had asked for the amount of pension, one of the things we asked for, and that was the amount of pension expense requested by the company for inclusion, and the amount of pension expense included in the commission's order if it could be derived.
I'm sorry, where were you referring to?
The very next, or I'm sorry, is it the next? Yeah, the very next page. So flip from where we were to page 22 of my surrebuttal exhibit, OCS 2.7S.
Okay. In some of those instances, there were settlements where nobody knows, and in some of those instances, you could derive it, right?
Yes, there are many where it's silent in the order, and the company indicates that the amount it requests in expense is unavailable, so I don't know if that means, I assume that means they didn't have the records to tell what was in their filing in that case for the requested amount. So really, we don't have the amount of expense requested or the amount included in revenue requirements until the 2013 docket.
Let me just add, oh, go ahead. As we sit here today, you don't have any basis to say that these contributions that far exceed the expense in this one we've been looking at, that didn't in fact come from shareholders?
No, nor do I have the information needed to tell if it came from ratepayers. I do know that the $75 million contribution by Dominion Energy Incorporated under the merger commitments did contribute to that net pension asset fairly substantially.
Sure. Now, we agree that it's a $112 million asset for DEU that's in that pension account?
That's what the company's indicated, yes. I have no reason to dispute that that's what's recorded on their books as the prepaid pension asset.
Right. And so the only way to know, when we talk about a prepaid pension asset, that's the cumulative contributions from the time over the life of the pension trust. Isn't that right?
That prepaid pension asset is the difference between the cash contributions compared to the amount of net periodic pension costs booked by the company.
Right. My only point is it's the cumulative total from the beginning of the trust forward.
Yes.
Right. The difference there that you've just highlighted.
Yes.
Okay. So when you did your chart, you only started in 2014. You did not go back any earlier, so that chart is incomplete in the fact that it doesn't take into account all of the contributions that took place prior to that time.
Yes, I don't believe my chart was intended to show what has been funded by shareholders versus ratepayers over that time frame. In fact, let me find my chart. And again, this chart, it's in my surrebuttal testimony at page 45. I believe it's line 965.
Right. That's where I'm at.
That shows the information from 2014 through 2019. And again, that chart's now, the amount of pension expense included in rates in that chart would need to be changed based on Mr. Feltensaw's correction.
Right. Yeah, and I was going to follow up with you. You agree that...
Go ahead.
Sorry.
Oh, I'm just, to say, as explained here in the testimony, I'm just showing in recent years how the amount of pension expense recorded in the company's books is compared to the amounts incorporated in rates charged to customers. And these years would cover the period during which that $75 million contribution by Dominion Energy shareholders would have occurred.
Right. I understood. I don't want to spend a lot of time on the chart other than to point out it is at this point would need to be updated and corrected, right?
Yeah, and it'd be easy to do. You could just replace the 8 million with the 5.6 million. I don't know if I agree it needs to be updated because I'm not recommending any adjustments based off this. I didn't adjust for this amount.
I'm just saying if you were going to be relying on it, it's not, the numbers that in there are not currently accurate. That's right, isn't it?
Yeah, the total cumulative difference from 2014 to 2019 would still be significant, but lower than that $46.65 million number.
And this chart also doesn't take into account the $75 million contribution, isn't that right, too? It would be inaccurate in that respect as well?
No, what this chart shows is the difference between the pension expense included in rates and the pension expense recorded on the company's books. This chart doesn't provide the cash contributions or what happened to that pension asset during that time frame. This chart is just showing the difference between what has been booked on the company for the pension plan costs and what's been included in expense and rates.
I'm going to switch subtopics, but I want to move to admit hearing exhibits 11 and 12 into the record at this point.
If anyone objects to the motion, please indicate to me. Okay, motion's granted.
May I approach?
Yes.
Okay. I'd like to ask you if you recognize Exhibits 13 and 14.
Just to make sure I have the numbering correct, is 13 the response to OCC, or OCS data request 1012?
Yes,
Okay. And that was 13?
that's correct.
Okay, and then 14 would be the response to OCS 11.12. Yes, I do recognize these.
Okay. And these were responses to OCS data requests, correct?
Yes, they are.
I'd like to talk first about 10.12 for a moment. The request here was that, as it relates to Mr. Stevenson's testimony on the total O&M budget, the questions were, please provide the amount included in the $151.6 million total O&M for energy efficiency expenses. And then B was, please provide the amount included in the $151.6 million total O&M for pension expense or pension credit. You see that?
Yes.
As it relates to item B, the answer was the amount included in the 2020 O&M budget for pension is a credit of $2.8 million, right?
Yes.
That is not the number you have used in your adjustments or your proposed adjustments in this case, isn't that right?
That's correct. My numbers are based on what the company provided in the filing, which was not revised in its rebuttal filing. So the amounts included in my testimony is reversing the company's adjustment for that 446 million.
Understood. Now I want to make clear, so the company has disclosed to you that the actual credit amount as of the date of this discovery response was 2.8, not 5.4, which is what you're using.
Yes, again, this was provided after the company's rebuttal testimony was filed. The company didn't update the rebuttal testimony, so I didn't seek data requests. If they had changed it, I would have asked for more information, like, for example, the information provided from the external actuarial firm calculating that difference and change. No, I did not update the number in my rebuttal.
The company didn't update, isn't it true, because the company doesn't agree with any of your adjustment on this total?
I don't know why they did or didn't update, because they do have the amount in the test year, and then they reversed that amount. They didn't update that, no.
You had this information, but you didn't update your amount that you've included in your adjustment. Isn't that's right?
That's right. This response was provided November 25th. My testimony was due December 5th. I wouldn't have had the opportunity to seek the actuarial information that demonstrates what caused that change.
But if the
So I didn't include it because I didn't have enough information to do so.
If the commission were to approve your proposal on that point, there would be an additional $2 million over and above what's actually in the credit today, right?
Well, not today because we're in 2019. What's currently budgeted for 2020 is this 2.8 million.
Right.
And I have no way to, like I said, affirm the accuracy of that.
Did you ask a follow-up to ask whether it was accurate or not, or seek any further information on that point?
Yeah, I didn't. Part of it was the timing of which I received the company's rebuttal testimony. As quickly as I could, I got out data requests. The response came in November 25th, and my testimony was due December 5th.
And it was a 5-day business turnaround, so you had time to ask follow-up questions if you wanted, isn't that right?
I could have asked, but I'm not sure I would have gotten the response on time.
Why do you think that? Had the company failed to provide any responses in a timely fashion up till that point?
No, they didn't.
Okay.
And I'm not saying that that's not what the number is going to be. I just have no way of confirming it.
Okay. Now I want to go to Exhibit 14 for a moment. This is a response to OCS 11.12. And the relevant information I want to talk about there is you asked a question relative to the pension. It says in the last rate case, docket number 13-057-05, DEU included and the commission approved a pension accrual amount of $8.18 million. And then you ask, please provide the source of the documentation. You ask to provide a citation to the commission order where it says that, and then you ask to provide the sections of the company's filing that show the amount of that pension. And in response, the company provided to you that attachment 1 is the settlement model from the general rate case for that case, and it showed that the $8.1 million discussed by Mr. Felsenthal is shown in the tab labor forecast in cell G11. But then it goes on to state, in that case, an adjustment of negative $3,805,815 was made to the pension and OEB expense in settlement. This adjustment is discussed in the partial settlement stipulation on page 4, paragraph B, and then it says this stipulation is attached as OCS 11.12 attachment 2, and the orders in the case can be found at the Public Service Commission website, and they provide you with a link. Isn't that right?
Yes, they did.
So prior to you filing your surrebuttal, you had this information as well, and you didn't include it in your surrebuttal.
I guess I misunderstood this response when I read it. I didn't realize when I read this response that that was an attempt to correct Mr. Felsenthal's testimony at that time. So I misunderstood the response the company provided.
Okay, I move to admit exhibits, DEU hearing exhibits 13 and 14.
If anyone objects to the motion, indicate to me. I'm not seeing any objection in the room, so the motion's granted.
Okay, last couple of points I want to cover. I want to understand under your proposal, if the commission were to accept your pension proposal, you have not adjusted it down to the what did we say it was? $2.8 million credit number. You've kept the 5.4 number. So under your proposal, if the commission accepted that, $5.4 million would be included in this rate case to reduce the revenue requirement the company is seeking in this matter. Do I have that correctly?
Yes, if they included the amount recommended in my testimony that was based off the company's filing, it'd be a $5.4 million. Well, it'd be less than $5.4 million in revenue requirement because you apply the Utah factor.
Sure.
I believe it's around $5.2 million roughly.
Thank you for the clarification. But I have the gist essentially right, don't I?
Yes,
Yeah.
yes.
Okay. So the company's cost of, that revenue requirement represents the company's total cost of service, right?
Yes, the total revenue requirement, the total amount of revenue it needs to bring in to achieve its authorized, or the ultimate rate of return found to be appropriate by the commission.
So if we subtract that out of the revenue requirement, that leaves the company in a position where it has a cost of service that is X and an actual recovery from customers that is X minus $5.4 million, right?
Yeah, I'm sorry, could you repeat that? Are you saying that because, I don't, repeat the question, I'm not sure I understood it.
I will. If the commission accepted your proposal, the company's cost of service would not change, right?
Mm-hmm. Correct.
But the revenue requirement would be reduced by $5.4 million.
No, I guess we're, I consider the cost of service to be the revenue requirement. And the revenue requirement, in my opinion, is $5.4 million less than what the company contends.
Fair point.
Because on its books and records, it is going to record a pension credit in 2020.
Let me clarify then. Using your terminology, if we say the revenue company's revenue requirement, which the cost of service is, if that were X, whatever number that happens to be, your proposal would say that customers are actually, the company's actually going to be able to recover from customers X, that total, minus $5.4 million.
No, I'm saying what X should be is that X amount should include that adjustment to remove $5.4 million because that is part of the company's overall revenue requirements.
So we do disagree about the difference between what the company's actual cost of service is and revenue requirement then?
I guess if you're talking about cash, if we were to sit down and calculate revenue requirement based on cash coming in and cash coming out of the company, most numbers in this case would change.
Let me
So
do it.
I don't equate cost of service to cash accounting.
Let me do it this way. Let's say the company had a payroll expense of $20 million. Under your theory, they would have a $20 million expenditure, and that's what they actually have to pay out to employees, right? But because the company, under your scenario, would not be able to collect that full 20, it's only going to get to collect 14.4. There is a gap between what the company will incur in cost and what it will recover from customers of $5.4 million, right?
I don't agree. That's way too simplistic of a comparison. There are a lot of items included in the revenue requirements that aren't based on the cash flow and where the cash is going. Two prime examples are income taxes. There were a number of years where there was zero income taxes being paid to the federal government under bonus depreciation, yet appropriately income tax expense was included in rates. So that isn't tied to cash. Depreciation expense. The company, when it books depreciation expense, isn't paying out a cash expense of that amount. Under accrual accounting, there are many areas where the accrual basis and cash basis differ, and rates and revenue requirement aren't set on a cash basis of accounting. They're set on the accrual basis of accounting in every jurisdiction I'm familiar with.
I don't really think we have a quibble, but I want to, so I want to make sure we are clear. The company has represented that its cost of service, its revenue requirement, that it needs to recover in order to pay all of its costs is X. You follow?
Yes.
You're saying that the company's position ought to be reduced by $5.4 million.
For this one item, there are many other adjustments.
Understand.
Yes.
All other things being equal, you're saying that the company should not recover $5.4 million of what it believes its cost of service is.
Of what it believes its cost of service is, which differs from what I believe the cost of service is.
And if the company is right that that's what it costs, it costs it to recover, to serve these customers, it will have a gap of $5.4 million that it needs to come up with from some place, right?
I disagree, again, because we're not determining rates based on the cash basis of accounting. There are other areas that are not based on cash basis. You're not going through every expense item by item to figure out what the cash amount is. So I think we're going to have to agree to disagree on this.
All other things being equal. It's true, you're asking to reduce by $5.4 million.
I'm saying that the company's revenue requirements are overstated by $5.2 million.
Okay, 5.4 is my understanding.
Well, 5.4 is the total company basis. I guess I'm focusing on the Utah jurisdictional amount.
Okay, so if the company's right and it needs that money to pay its costs, it will have to get that money from someplace else, right? If it can't get it from customers in rates, it has to recover it from some other location.
Yes, and again, it's my opinion that the total revenue requirements recommended by the office in this case will allow the company the opportunity to meet its full revenue requirements.
I know that's your position. I understand, and I don't want to quibble anymore. So if the only other source the company would have at that point to recover that money would be to get it from shareholders, isn't that right?
I don't know what sources. For example, depreciation expenses included in rates. So the company's collecting revenues based on that depreciation expense. It can use that amount to contribute towards new capital additions, to pay dividends to shareholders, to pay back debt, or to help maintain its operations. You don't go through and determine revenue requirements and how those revenue requirements are funded on a item by item basis.
You don't do single item rate making is what you're saying.
Well, we don't take payroll expense and say, well, that's being paid from these funds. I mean, it is covered by the revenue requirements.
You're picking out one item, though, in your approach, and essentially wanting it treated exactly the way you're telling me that we don't normally do it. You're picking out an issue of pension and saying customers will be overpaying, or if...
Is there a question, or are we just making comments here?
Yes, there's a question coming if I can finish my comment. You're picking out one item, and you're saying that in a bucket of a bunch of things, right? And that one thing you're picking out and saying that customers are going to overpay on that one item, when in fact the company has under-recovered since the last rate case. So my question is, that's precisely what the company's saying, isn't it? That you shouldn't be isolating this one item and saying that customers should get that subtracted off of the top.
And again, I'm not subtracting that one item. It's the company that removed that amount that it's going to record on its books and records in its filing. I just added it back in. It's the company that initially picked out that one item and removed it from its revenue requirements. And I disagree that it should be removed.
Okay.
I'm going to respond to Mr. Snar's objection. I think we're pretty far into asked and answered territory at this point.
I'll move on.
On this issue, okay.
Sure, great. The company's proposal is to take all pension items out of the revenue requirement, correct?
Yes.
And in doing that, the company has not proposed to charge customers anything for a pension expense, even if it's taking out the credit. In other words, the company is not, by not including the credit, it's not turning around to customers and saying you need to pay a pension expense, correct?
Because there is no positive pension expense in 2020. So I would agree, the company isn't increasing revenue requirement to add pension expense. It's just taking it to zero.
What I'm saying is even by taking out the credit, they're taking out the credit. Even in taking out the credit, they're not turning around and at the same time charging customers a pension expense. Correct?
Correct. They're including zero for pension expense in their revenue requirement in this case.
Okay, and those funds that are in the asset account, the pension asset itself, including the money that the company has contributed, will defray customer expenses, any pension expense for customers for the foreseeable future. Correct?
Yes, the total amount in the pension fund served to reduce or what would otherwise be the pension expense.
No further questions. Thank you.
Any redirect, Mr.
Just
Snar?
2 or 3 questions. Ms. Ramos, do you recall the date of the filing of Dominion's rebuttal testimony?
I have it right here if you give me a moment.
All right.
November 14th, 2019.
Thank you. Now, with reference to Dominion Hearing Exhibit 13, what is the date of the response that was provided to the OCS request in that particular data request?
November 25th, 2019.
And so as of November 25th, 2019, if we're looking at answer B, there's an item there that is at least contended to result in a change of information or data. Is that right?
Correct.
And also referring to exhibit number 14 that was presented, what was the date of the response provided by Dominion in that situation?
November 26th.
And that was the one that disclosed in the answer this adjustment that Mr. Felsenthal made in his testimony earlier, was that today or yesterday? Anyway, in this hearing, right?
Yes.
Yes.
Yesterday.
Yeah, it discusses that 8.18 million, including his original, and it indicates there's an adjustment to that. It doesn't provide a revised adjustment that was provided earlier today by Mr. Felsenthal.
As far as you know, did Dominion make any corrected, amended, or supplemental filings to reflect these changes in their application or the rebuttal position between the date of filing the rebuttal and the commencement of this hearing?
Not that I'm aware of.
Thank you. No further questions.
Any recross?
No.
Okay. Commissioner Clark, any questions?
I have a question about pension expense.
Okay.
And I really do, sorry.
Oh, no, it is, I've been doing this for 28 years, and pension accounting is probably one of the most complex areas of accounting that I deal with.
So setting aside intergenerational equity concerns, am I right in thinking about this credit that it's really not, we're not, if we were to allow the company to do what it wants to do. In other words, to bring it to zero and not recognize in this revenue requirement determination the credit, the $5.4 million credit. Are we, if we were to do that, would we deprive customers of the benefit of the credit, or just defer to some future time when there is a positive expense, when that credit would be recognized in rates, assuming we're setting pension rates at regular intervals, or
Yeah.
setting the revenue requirement at regular intervals?
No, that would never be made up for in the future, because in a future rate case, the actuarial firm will work with the company to determine the pension expense in that case. And it'll be how the numbers fall out at that time based on a lot of factors. But there's nothing that would defer this 5.4 or 5.2 on a Utah jurisdictional basis that would defer that credit to get it back to customers in the future. It'd just be gone.
So there isn't a time in the, let's say next, to even simplify this further, say that in 2021, there's a $5.2 million expense. And the existing, I'm thinking of it as a surplus in the account. Maybe that's a wrong way to think about it, but that surplus wouldn't then offset the need for the additional expense in the next year.
No, I believe you may be confusing the amount of assets in the pension plan and how that impacts the expense. So in determining the annual amount of net periodic pension costs, one of the factors used in determining that amount is you apply the company's anticipated return on its pension plan assets. And this is a simplified analysis because in the actuarial calculations, you get into market value of assets, and you may amortize gains and losses into that. So you don't take actually the amount in the pension plan and apply that 8.75, but that is a reasonable way to estimate the impact in this case. So in the next rate case, you still have assets in that plan. Some may have been paid out to retired employees, but you'll have other assets in there that hopefully would have grown if the companies had a good return on that in the interim. So by the next rate case, you then recalculate, the actuarial recalculate pension costs, and that'll still be a component. So you'll still apply the estimated return used in the pension calculations to the pension funds, essentially. So ratepayers will still continue to get the benefit of the actual earnings on the cash in that plan as a reduction or an offset to future pension expense as part of a component of calculating that expense. And I'm sorry it's a long answer, but pension accounting, we could sit here for a week and talk about little intricacies of it and how different items impact it differently. But I hope that was responsive.
Thank you. That concludes my questions. Thank you.
Okay, thank you. I think I have just one or two brief questions. I'm looking at page 62 of your direct, and let me just get there.
I'm there.
Okay, so towards the end of page 61, the beginning of page 62, I just want to make sure I understand both of the points you're making with respect to LNG case legal costs. I mean, I understand your second point. When you look at just the very top of page 62, or starting at the bottom of page 61, the costs associated with DEU's attempts to gain pre-approval of the LNG facility should not be passed on to ratepayers, and should not be incorporated in annual base rates to be charged to Utah ratepayers. And then you go on to explain the second part. The second part of what you're saying there is clear to me that you're making the case that those amounts should be removed from the 2020 test year. What do you mean by the first part when you say should not be passed on to ratepayers?
Yes, in my direct testimony, the recommendation that these be removed was twofold. I believe I explained this in my direct, that at that point, the company had the 2018 docket, and I believe I might have cited or discussed the commission order where it was rejected, partly because of not being supportive. And then the company turned around and again filed the 2019 case with additional information. And at that point, the decision on that 2019 case hadn't come out. The office was opposed to that project. So that was one reason for removal. I didn't view it as reasonable to pass costs associated on with that, particularly at that point in time when the 2018 docket had been rejected and prior to the decision of the 2019 case. Since that time, and by the time I wrote my SIR rebuttal, the project had, and I might be mincing the language a little bit, but pre-approval from the commission to proceed with that project. But it's still my opinion as expressed, I don't know if I expressed this in my direct answer rebuttal, that it should be removed because it's not reflective of your typical annual level of legal expenditures that you would incur.
Okay, sure. And that second part that you said, I think, is clear in your testimony and in your positions.
Mm-hmm.
I'm just trying to make sure, are you articulating an argument that any unsuccessful application should create a presumption that the costs associated with the application are somehow should not be passed on to ratepayers? That's the phrase I'm trying to understand.
In general, no, I wouldn't argue that. I have argued in a rate case in a different jurisdiction that when the company submitted a filing that wasn't supported and basically shouldn't have been filed, and the commission agreed that they shouldn't recover the costs associated with that case. And I don't remember which, or it was a long time ago in a different jurisdiction, and the commission had agreed those costs shouldn't be passed on to customers. But I'm not saying that in this case. At the time I wrote my testimony, it had been rejected in 2018, and then the company filed the application again. But no, I'm not recommending that.
Okay, so at the risk of doing an asked and answered myself, the phrase, the cost of the LNG facility, quote, should not be passed on to ratepayers. Should I interpret that phrase in your direct only to be referring to your suggestion to remove it from the test year? Are you saying any more than that?
Not in that sentence, no.
Okay. That's the only question I have. Commissioner White?
I have no questions, thank you.
You're welcome.
Thank you for your testimony this afternoon.
You're welcome.
We're ready for the next witness.
The office calls Daniel Lawton and asks that he be sworn.
Good afternoon, Mr. Lawton.
Good afternoon.
Do you swear to tell the truth?
I do.
Thank you.
How you doing?
Could you state your name and occupation for the record?
Sure. My name is Daniel Lawton, and I'm an economist who does rate consulting, and also I'm a practicing attorney, and I'm here today as a consultant.
On whose behalf are you testifying today?
Today, I'm providing cost of capital testimony on behalf of the Office of Consumer Services.
Have you reviewed DEU's application in this case and the various filings?
I didn't hear the question.
I'm sorry. Have you reviewed the application in this case and the parties' various filings?
I have indeed.
Have you prepared and caused to be filed direct testimony on October 17th, 2019 with exhibits 3.1 to 3.14?
Yes.
Have you also filed SIR rebuttal on December 5th with exhibits 3.1S to 311?
Yes.
And you also filed Exhibit 3.313, is that correct?
Could you repeat that?
There was a supplemental exhibit filed 3.13.
I believe so. I believe the office did to correct some copying errors.
Do you have any changes in your testimony you'd like to make today?
None that I'm aware of.
If I asked you the same questions that are in your written testimony, would your answers be the same today?
They would indeed.
Do you adopt this testimony as your testimony today?
I do.
The officer would ask to omit the testimony and accompanying exhibits.
If anyone objects to the motion, please indicate to me. I'm not seeing any objections, so the motion's granted.
Are you prepared to give a summary today of your testimony?
I am, and it'll be a brief one as well. Commissioners, the details are certainly in the direct and the sur rebuttal testimony. But my testimony here today addresses the issue of cost of capital. That is the company's capital structure, the company's cost rates for debt and equity. And when it comes down to it, the only issue that I dispute in this case is the cost of equity. The company, and you've heard testimony from company witness Hebert, recommended a range of, I think, 9.9 to 10.75, ultimately estimated 10.5%. I have proposed in my testimony, both direct and updated in my sur rebuttal, a cost of equity capital of 9.1%. Now, this is an important issue. You've heard a lot of numbers thrown around, so I'm going to try to just hit the highlights. But the difference between 9.1% return on equity and a 10.5% return on equity is about $17.7 million of revenue requirement. Subtract off an amount for income taxes, that's about $14.4 million in profits. So that's what's at stake with regard to the numbers. But given that my only dispute with the company on the cost of capital in this case is the cost of equity, I'm going to focus on the highlighted differences between the company's proposed 10.5% and my 9.1% recommendation. Now, our starting point for this case is 9.85%. That is the authorized equity return from this commission. In the 2013 case, I think the decision was made at the end of the year, say, start of 2014. Since that time, what has happened to the capital markets? Treasury rates at that time for U.S. 30-year yields for U.S. Treasuries were about 3.4%. Today, if you looked them up this morning, they would have been at 2.2%. Cost of equity authorized by commissions around the country since you made your last decision have also come down, albeit a lot less. The cost of equity seems to come down a little more slowly than some of the interest rates. But if you look at my OCS Exhibit 3.10, I'll just give you a quick reference. The authorized rates of return in 2014 were 9.78%. And if you look at them in 2018, to get a full year, apples to apples, they were about 9.59%. So you have about a 20 basis point swing in the authorized equity returns over the period since the last case. Now, I address in my testimony that the company's 10.5% request in this case is 65 basis points above what you last authorized. Yet the cost of capital has been coming down since you made your last decision. And another interesting point of reference for you in an analysis of this case is that we have 5 parties, including the division, submit cost of equity in this case. I've already said the company's at 10.5%. All of the other parties, if you assume a 55% capital structure for equity, All of the other parties are between 9% and 9.25%. There's a cluster on one end. So the other consideration is all the parties in this case employed the same financial models. You've heard about the discounted cash flow, the capital asset pricing model, the bond yield risk premium, and I'm not going to go through the details of the model, but everybody used them. Yet you have one group in the 9 to 9.25% range and one outlier at 10.5%, which seems to be the company's position. So to figure out what's happening here, because everybody's using market data, you look at the models, and I've looked at and I've pointed out in my testimony where Mr. Hevert's models differ substantially from what everybody else is doing in this case. I start off by looking at it, and it's in my direct as well as my rebuttal testimony. I address most of these issues. But in his DCF analysis, Mr. Hevert calculated results as high as 28.83%. Cost of equity. Well, that's just not reasonable. No commission's going to authorize that. Rather than exclude it, what did he do? He averaged it. And it's my position when you have outliers like that and you try to average them away, all you do is end up with a bad average. And you could go through his DCFs and find a number of things. I highlight the 28.83%, and if you look at a rebuttal, that number changed to over 30%. That's just not reasonable. The second problem with Mr. Hevert's models is with regard to his CAP-M and his estimated capital asset pricing model. In both of those, in his direct testimony, he uses forecasted yields of over 4%. Nobody's forecasting, those forecasts have come down, and I think that inflates as a result. But the key thing in those models is part of that analysis that Mr. Hevert conducted. He had to do a calculation of what's the market premium, and he estimated the discounted cash flow for all the 500 companies in the S&P 500. Some of those companies, he estimated a DCF that these investors would expect. Some of those numbers were as low as a negative 16%. Some of those numbers were as high as 115% return on equity. What does he do again? Mr. Hevert puts them in his average. And I just think you have to sit back as an analyst, look at that kind of result, and remove it. When you correct his analysis, it truly comes out about 8.8%. When you correct his DCF analysis, it comes out around 9.5%. And when you correct his risk premium, where he used the forecasted yields, it comes out about 9%. Overall, he'd be closer to the group that I talked about earlier. And it's just that an analyst has to use his judgment. Mr. Hevert's judgment is to employ averages, and I just don't think that does it. And I think the results in this case kind of show that. Now, I'd like to move on to bond ratings and financial metrics. It's my position that a 9.1% return on equity will provide ample financial metrics and cash flow. It's not only my position, but if you look at Mr. Hevert's rebuttal in this case, he agrees with me. And in my rebuttal, I pointed out what Mr. Hevert claims is that Mr. Lawton's 9.1% doesn't provide enough cushion, enough profit cushion, because if we don't, if our costs go up or we don't earn enough, we may fall out of that benchmark area. Well, commissioners, I have to totally disagree with that, because the profit cushion he's asking for in this case is the difference between 9.1 and 10.5. That's $14.4 million. I don't know how you tell customers that we recovered the cost, we allow the commission to recover their costs, the company to recover their costs, but we had to give them a little extra cushion on profit. I've never heard of such a thing, but that's in his testimony, and I addressed that in my rebuttal. Lastly, we have DEU's business and financial risk. This company, and it's shown in a number of exhibits in this case, has an infrastructure tracker. It has weather normalization as well as decoupling. And these kinds of factors certainly protect cash flows. And let me give you one example, and I pointed it out in my testimony. The infrastructure tracker alone, the projections are that from the end of this rate case over the next few years, they're going to have $240 million of investment, roughly, under the tracker. And I guess 4 years. And over that time, this company will be allowed, on an interim basis, to increase its rates over $30 million, no matter what you do in this case. As long as that infrastructure exists, the tracker, and they have this investment, customers' rates are going to go up over $30 million over the next 3-4 years. Lastly, capital structure. I agreed with the company's 55% capital structure in this case, and I also pointed out that capital structure is a little high. It's an anomalous result. Since the Tax Reform Act at the end of 2017, companies across the country have been boosting equity ratios because of the cash flow impact. And more recently, in 2018, a settlement was reached and an order passed by this commission allowing the company to increase their equity ratios beyond what was agreed to in the merger/acquisition agreement in those ring fencing provisions. So I felt that if I adjusted the capital structure, I mean, what was the point of the settlement? And I know parties were not bound by that settlement, but I just felt that you just made that order. Let's leave it at 55%, allow them to improve those cash flows, but let's set the rate of return at the level it should be at, the market cost. Last point before my conclusions. We've heard a lot about the recent authorized equity returns are about 9.7%. Actually, that exhibit, the AGA, American Gas Association, for 2019, it's 9.68. Well, that's with a 52.52% equity capital structure on average. If you want to compare to a company with a 55% capital structure, that 9.68% has to be adjusted downward by about 35 basis points, so it's truly about 9.33 if you adjust for capital structure, because that reduces financial risk of the company. So we have a cluster, just to conclude, of all the parties in the 9 to 9.25 range. The recent authorized returns for 2019, the evidence in the record indicates about 9.33% when you assume a 55% equity ratio. And then you have the company at 10.5, which can't be explained other than the points I brought up earlier. And that concludes my summary. Thank you.
Mr. Lawson is now available for cross and questions from the commission.
Okay, I think it's a good time for maybe a 10-minute break right now, and then we'll come back and do any cross-examination questions. Thank you for your summary. We'll be right back.
Oh, I got to come back though, right?
You have to come back, yes. And we're ready for cross-examination for Mr. Lawton, is that right, Mr. Moore?
That's correct.
Okay. I will start with Major Kirk, I think. Do you have any questions for this witness?
Yes, sir, I do have a couple questions. Good afternoon, sir.
Good afternoon, sir.
I have a couple questions for you on your capital structure in this case.
Yes, sir.
You indicated during your summary you didn't propose any changes to the company's 55% capital structure proposal. Is that correct?
That's correct. I've retained the 55% equity ratio, 45% debt.
And that 55% equity ratio, that was based off of a settlement in the acquisition case that took place approximately 3 years ago. Is that correct?
No, not quite. The company DEU requested an amendment to the acquisition requirements and to go above 55%, and I think that was decided in 2018, I forget which month, and it was recently decided, so I wasn't going to change it. I mean, what was the point of that exercise and the commission's efforts?
You'd agree that we now have a test year for 2020 numbers, right?
I do.
And so you could have performed analysis based off the 2020 test year numbers to determine what would be a fair equity ratio.
I did not. Other than to say, I mean, typically the equity ratios you see coming in for gas utilities around 52.5%. I pointed out in my testimony that this equity ratio is somewhat of an anomaly because of the tax impacts, and I expect it to go the other way, and that's why I just chose 55%.
And by tax impacts, you mean the Tax Cuts Jobs Act impact?
Yes, sir.
And other utilities, you'd agree, are impacted by that same act, correct?
That is true, and some of them have higher equity ratios, most of them have lower.
And the current average, you agree, is around 51 or 52%?
52 to 52.5, somewhere in that range, yes, sir.
But in this case, you still support your opinion of 55% capital structure?
Yes, as I stated in my testimony as well as my summary, that the recent decision by the commission, the settlement of all the parties, albeit nobody's bound in a rate case, that decision was just made for the purpose of improving cash flows. So I said, why change it now?
Thank you.
You're welcome, sir.
Mr. Meekum, any questions for Mr. Lawton?
Thank you.
Mr. Russell?
No, thank you.
Okay. Mr. Jetter?
I have no questions. Thank you.
Thank you, sir.
Ms. Clark or Mr. Saban?
Yes, thank you, sir. Well, appreciate you being here today.
Oh, thank you. Good to meet you.
Yeah, good to meet you. Would you open up there's a binder there behind you that has the testimony for the parties in this proceeding, or for the office. Oh, excuse me, no, I apologize.
This one?
You have your own, do you have your direct testimony someplace there?
I do.
Just refer to that, that will be easier. If you've got it,
Say that.
your direct testimony.
Okay.
Good clarification. When you get your direct testimony, would you open it up to page 34?
Almost. I'm there.
Okay, I'm going to start at the very top of the page, line 801. Your question is, have you reviewed credit research reports for the company regarding credit quality and corporate financial metrics? And the answer you provide is yes. The company's credit quality is not threatened or under pressure of downgrade. I have discussed these issues earlier with regard to the recent Moody's and S&P credit reports. That's what your testimony states there, right?
Yes, that's what it states.
Yeah. You're aware, having been in these proceedings to some extent, that there was in fact a credit downgrade?
There was indeed by, I believe, from A2 to A1, or A3, excuse me, A3. I was going the other way, I was optimistic. But it was A2 to A3. There was a slight downgrade, but that was to be expected given as I recall, you were on negative watch throughout that time.
Yeah.
And that's the ultimate result sometimes.
Understood. Now, if you'd grab that binder, in that binder there's three exhibits, or actually, I'll just probably do two exhibits. If you'd grab that, I'll point you directly to what I want to talk about.
All right, give me a tab number then.
So it should be DEU Exhibit 1.05, which is attached to Mr. Mendenhall's direct testimony.
And what was the number again, sir?
It's Exhibit DEU 1.05. You may actually have it right there. Is that?
This is the Moody's. I just went to tab 5, and it looks like there's an R after it, so that would be the rebuttal. Is that right?
It's probably tab 5 after the first. It might be that one you're looking at right there.
Okay.
Is that dated January?
No, August 19th, 2019.
Oh, you're going to have to, I apologize. You're in the rebuttal testimony. If you move a little bit forward to Mr. Mendenhall's direct testimony, it will be tab 5 to that.
I apologize.
No, that's okay. It's a little confusing.
I'm there now.
Okay. Perfect. This is a January 2019 Moody's report, right?
Yes, sir.
And I want to just turn, if you could turn to page 2, I want to focus on the factors that could lead to a downgrade. One of those, the top factor was cash flow to debt metrics below 20% on a sustainable basis, right?
I see that.
And it was after this that there was a downgrade. That's right, isn't it?
Yes.
And one of the factors cited by Moody's for the downgrade was that this factor was not satisfied. There wasn't cash available. The cash flow to debt metrics was below 20% during that period of time.
I don't recall. Do you want me to look at the?
We'll go to there in a second.
Okay.
Suffice it to say here, Moody's wants to see, to maintain this credit status, Moody's wants to see sustained cash flow that is above 20%.
20% or above.
Or above, yeah, thank you. 20% or above, right?
Yes.
And now if you would turn with me to, now go to the rebuttal testimony there. And there it's Exhibit 1.01R, also to Mr. Mendenhall's testimony. It's rebuttal testimony there.
Yeah, I think that's the one I had a moment ago.
Yep, I think that's right.
The August 19th credit opinion?
Correct,
Got
that's
it.
the one. Turn to the same second page. Want to highlight that factors that could lead to a further downgrade. Do you see that, or to a downgrade?
Yes.
One of them is cash flow to debt metrics below 16% on a sustained basis.
Yes, because we're one notch lower.
Right. So do you agree with me that Moody's expectation appears to be that if you want to be up in the A2 category where you were, you need to have cash to debt ratio of 20% or higher, and if you want to maintain the A3, you better be at 16% or higher?
Based on the analysis or the statements from the prior Moody's and this Moody's, the answer is yes.
Okay.
But you're in a fine place as it is, at A3.
Understood. Let's go now to your testimony. Your direct testimony, you had an Exhibit 3.11.
I'm there.
Okay. This is a chart you prepared as part of your analysis, is that correct?
It is.
I want to go down to the bottom half of the page. There's a chart there that has an A, B, and C columns. Do you see that?
Yes.
My understanding is that the A column is intended to represent the company's requested capital structure and a 10.35% ROE.
No.
No?
It's actually 10.5.
Oh.
I think that 10.35 is somewhat incorrect, and the 9.2 next to it should be 9.1.
Okay.
So I did have corrections.
I was going to ask you if both of those things, so I appreciate you clarifying. So column B is what you propose, isn't that right?
That's correct.
Now, if I go down to line 11,
Yes, I'm there.
that's intended to be the cash to debt ratio number, right?
Yes,
So if we followed your proposal, or let me just say, apparently some of the other proposals might be the same, but your proposal would result in a cash to debt ratio of 15.61%.
that's a cash flow from less dividends over debt.
But you'd essentially leave the company at the end of the day, your operating cash would be to debt ratio is 15.61.
Right.
Right, which is below what we just read in Moody's would be required to maintain A3 status, correct?
I'm not clear which one, sir,
Yeah.
if you don't mind, let's stay with my exhibit OCS 311. And on lines 10 and 11, we have two cash flow to debt calculations. One excludes dividends, that's the one on line 11. The one on line 10 doesn't. I don't know which cash flow to debt ratio they were referring to when we read that part of the Moody's report, so maybe you can help me.
Well, let me back up for a second. Do you understand, or can you accept, subject to check, that the company has not issued any dividends?
I think I can accept that.
Okay. So if you want to flip now back to the Moody's report,
I'm here. Which one?
I'm talking about the one in August with the downgrade,
Yes,
and we're on page 2.
yes.
It just says cash flow to debt metrics below 16% on a sustained basis. So if we're not dealing with dividends at all, what we're talking about is the operating cash to debt ratio, isn't that right?
Right, and I took dividends out on line 11. I presumed a dividend payment with a payout ratio, as I recall, of 60% in that calculation.
Okay, and why did you make that assumption?
Because most utilities do, in fact, pay dividends, and this company will push dividends up to its parent at different intervals as cash is available. And so I just used an average payout ratio. I employed 60%, and that's what I took out on both line 11, columns D and E. So if we want to get to a realistic comparable number, then we should only be looking at line 10, and because you said the company's not paying out dividends, and so we're at 24% and 22%, meeting all the requirements for even an A2.
Now, even if we were to dividend up, as has been suggested by some of the other parties, or to bring the equity ratio down from its actual ratio at 60% down to something closer to 50 or 52%, which is what some of the other expert witnesses have testified about, that would employ your line 11, wouldn't it? At that point,
Not necessarily. It just depends on how you're going to do it over time and what kind of payout ratio you're going to employ. And
what did you assume? What did you assume in line 11?
I assumed 60%. I also assumed a 55% equity ratio in this case, so you wouldn't have to go to this.
Totally
I'm on
understand.
your side on that issue.
I'm not, and you'll notice I'm not quibbling with you on that issue. My point is, if you're going to pay out some dividends and take that cash out of the operating business to pay dividends, you're going to drop the ratio of cash to debt will go down.
It should.
And
yes.
it could, if we were to do what other parties are suggesting, you could in fact be below the 16%, which would be required to sustain A3 status.
Yeah, lots of things
Right.
could happen. You're asking that I speculate. I don't know what is going to happen. I mean,
Right. Okay. And I think you agree with me on this. So you agree that the Tax Act has had a significant impact on the available cash, for the company's availability of cash to do what it maybe would have done in the past.
That's a tricky question. You used the word significant, which is a very ambiguous term. The Tax Act had an impact on cash flows, but whether it's significant or not depends upon the utility.
Do you have an opinion here about the reduction and how much it affected the company's performance?
I think it's not as bad as some utilities were hit by it, but it was impacted by the Tax Act. And what we have to remember is the Tax Act is turning around. In other words, DEU is going to have a bigger rate base in the future because of the Tax Act, because there's less deferred taxes to deduct. And so that's when you're going to start seeing that cash come back to DEU after a few years.
Right. Perhaps in the next rate case, right?
I'm looking.
Okay. All right. I don't have any other questions. Thank you.
Any redirect?
No redirect.
Okay, Commissioner White, do you have any questions for him?
I have no questions, thank you.
Thank you, Commissioner.
Commissioner Clark?
No questions. Thanks for bringing us up to date on your equity ratio views, given what you've sat through the last 2 days. Thank you.
Okay. Well, thanks, sir.
I don't have anything else. Thank you for your testimony this afternoon.
Thank you, Mr. Chairman. May I be excused?
Yes.
Thank you.
Anything else from the office?
The office has no more witnesses.
Okay.
travels.
I'm sorry. What?
No, I was just telling him safe travels, sorry.
Oh. Mr. Russell?
DOE calls Mr. Kevin Higgins.
Good afternoon, Mr. Higgins. Do you swear to tell the truth?
I do.
Thank you.
Good afternoon, Mr. Higgins. Could you tell us your name and on whose behalf you are testifying?
My name is Kevin C. Higgins. I'm here on behalf of the Utah Association of Energy Users Intervention Group.
And did you prepare and cause to be filed direct and surrebuttal testimony in this docket?
Yes, I did.
And just to be more specific, direct testimony along with UAE Exhibits 1.1 through 1.8 and surrebuttal testimony along with UAE Exhibit 1.1S. Is that right?
That is right.
And do you adopt that pre-filed testimony as your testimony in this proceeding?
Yes, I do.
Do you have any proposed, or do you have any changes to propose for that testimony?
I do not.
Okay. At this point, I'll move for the admission of Mr. Higgins' pre-filed direct and surrebuttal testimony along with the associated exhibits.
Okay, please indicate to me if anyone objects to the motion. I'm not seeing any objections, so the motion's granted.
And Mr. Higgins, before I have you provide us with a summary of your testimony, there is one line of questions that I have for you. You have, I gather, listened to the testimony either on an audio feed or live here in the hearing room. Is that right?
That is correct.
And have you listened to the testimony of Mr. Felsenthal and also Ms. Ramus today regarding the amount of pension expense that has been included in rates since the 2013 general rate case?
Yes, I have.
I'd like to turn your attention to your direct testimony. Is page 12 of your direct testimony, line 219. Do you have that?
Yes, I do.
Okay, I'll give everybody else a moment to catch up. In that line, you indicate that Dominion's current Utah rates include $7.9 million per year in pension expense based on projected fast pension cost at the time rates were last set in 2014. Do you have a correction to make to that number?
I do not.
Okay, and now we've heard Mr. Felsenthal correct his testimony regarding the number that was included in his pre-filed testimony, and that was not the same as the number that you have here. Do you want to explain why you think this number is correct?
Yes. I do believe that Mr. Felsenthal's original number was incorrect, so I do believe it correcting it was appropriate. However, I do not believe he corrected it to the right number. The The $7.9 million referenced in my direct testimony cites to the Phase 1 technical conference handout that the company had provided. However, I also corroborated that number with my own records from that case in which I was a witness. And in fact, I participated in the settlement agreement in that case. And based on my experience in that case and my knowledge of that case, the correct number, as I understand it, in terms of what is the amount of pension expense in rates currently, is approximately $7.9 million. And if folks want to check the math on that, I suggest they look at the company's response to DPU 19.03, attachment 3, that was provided in that case. And in that case, that attachment will show that the company's original filed Utah revenue requirement for pension expense was approximately $10.8 million. And the company updated that number with more current information during that case, and the update was approximately $7.9 million. And in that case, I made an adjustment, I recommended an adjustment, to simply move to the updated number. It was not a complicated adjustment, it was simply the difference between the original filing and the updated filing. And that adjustment was the adjustment that was accepted in the settlement agreement that was approved by the commission. The adjustment was $2.9 million approximately. So as I understand the record of that case and my participation in that case, my belief is that the correct number that represents what is in rates today that customers pay for pension expense is $7.9 million. I believe the number that Mr. Felsenthal originally used that was incorrect was simply the Questar gas portion of pension expense, which was $8.18 million. However, pension expense also includes an allocation of Questar corporate pension costs. And that's why the total number that was in the revenue requirement was in fact about $10.8 million, and the updated number was $7.9 million. And the adjustment simply corrected to, or moved to the updated number.
Thank you for that. And have you prepared a summary of your pre-filed testimony?
Yes, I have.
Go ahead with that, please.
Good afternoon, Mr. Chairman and Commissioners. I'm recommending several adjustments to DEU's requested revenue requirement. First, I recommend adjusting Dominion's non-labor O&M expense to remove the inflation component. In my opinion, utilities should not be rewarded for their choice to use a future test period by being allowed to build indexed inflation projections into their O&M expense. The primary justification for using a future test period is to allow a utility with expanding rate base the ability to avoid regulatory lag. This is a significant benefit to the utility. This benefit should not be further enhanced through a cost cushion that allows Dominion to inflate its baseline costs by applying an indexed inflation factor through the end of 2020. Instead, rate making should signal to Dominion that it should strive to control its O&M costs through increased operating efficiencies. Indeed, over the past several years, in between rate cases, Dominion has done just that. Now that we are in a rate case, it is not reasonable to simply gross up the company's base period costs by an inflation factor and pass these higher projected costs onto customers. So my adjustment reduces the Utah revenue requirement by approximately $1.9 million. Number two, I recommend a revenue requirement adjustment of approximately $5.3 million to account for the negative pension expense that Dominion is expected to experience in 2020. Sound rate making requires that my adjustment be made. Dominion proposes that pension expense be set at zero in this case, rather than recognizing the negative pension expense in rates. In Utah, and in most jurisdictions in my experience, pension expense for rate making is based on net periodic pension costs, calculated in accordance with generally accepted accounting principles, or GAAP, with some adjustments for capitalized labor. Dominion's proposal would be a significant ad hoc departure from this standard practice. The company appears to be seeking a long-term arrangement in which customers would pay for pension expense in rates when GAAP pension costs are positive, but would go without a credit in rates when GAAP pension costs are negative. Such an asymmetrical long-term arrangement is not reasonable. Over the life of a pension plan, the cumulative sum of GAAP pension cost, including negative pension cost, is expected to equal the cumulative sum of the company's funding contributions. This means that setting customer pension cost responsibility in rates equal to GAAP pension cost, as is currently done, ensures that by and large, customer rates will fully fund the pension plan costs over the life of the plan. Now, I use the qualifier by and large simply to call out or recognize what we all know, which is that rates are not reset every year. So that the pension expense that is set in rates doesn't change until the next rate case. So that it's not going to, because of that, and because of that alone, setting pension expense in rates equal to the GAAP pension costs will not exactly match the contributions by customers over the life of the plan. But if you did reset rates every year, it would. So conceptually, the practice of setting pension expense in rates equal to the GAAP pension cost will achieve the desired outcome of having customers fund the pension plan over the life of the pension plan. Selectively zeroing out pension expense in rates when GAAP pension cost is negative, as proposed by the company, will cause customers to overpay for pension cost over the life of the pension plan. Embarking on such a practice of systemic adverse selection is not reasonable. Now, if in the alternative, Dominion were proposing to eliminate negative and positive pension expense from rate making on a permanent basis, then I believe the company's proposed treatment would be worth consideration. However, the company indicates that it is not supportive of such a permanent change. Therefore, in the absence of such a commitment by the company, my recommended adjustment should be adopted. Number 3, the Commission should approve my recommendations related to excess deferred income tax, or EDIT, or EDIT, most of which Dominion accepted in its rebuttal testimony, including my recommendation to credit customers with the amortization of plant-related EDIT occurring between January 2019 and February 2020 through an extension of the Tax Reform Sur Credit 3, which I refer to as Tax Reform Sur Credit 4 in my testimony. One of my objectives in addressing EDIT in this case was to ensure that the benefit to customers from amortizing plant-related EDIT between January 2019 and February 2020 did not slip through the cracks. This goal is accomplished through the extension of the Sur Credit. A second objective was to change the going forward amortization of non-plant EDIT from 30 years as initially proposed by the company in this case to 10 years to ensure more timely recognition of these benefits to customers. But as I looked into these two issues, I realized there were a couple of housekeeping items related to EDIT that also needed to be addressed. Namely, A, updating the 2020 plant-related amortization to DEU's latest estimate, and B, restating rate base to reflect EDIT amortization starting January 1, 2018. Dominion responded to my EDIT recommendations in a very forthright and helpful manner, which is my way of saying they accepted most of my proposal. The only remaining difference between Dominion and UAE on this issue is the amortization period for non-plant EDIT. DEU is recommending 12 years, while I continue to recommend that non-plant EDIT be amortized over a period not to exceed 10 years. My recommended base revenue requirement, EDIT adjustment, increases the Utah distribution non-gas revenue requirement by about $478,000. But it is packaged with a 12-month extension of the tax reform CERC credit beginning June 1st, 2020, that would provide customers with a credit of approximately $3.6 million over that period. Number 4, I recommend that outside contractor expenses be removed from the revenue requirement, as identified in my testimony, and it's identified as a confidential amount. The project that these expenses pertain to are not related to distribution non-gas service, as far as I can tell. And for that reason, it should be removed from the distribution non-gas service revenue requirement. In addition to my revenue requirement adjustments, I recommend that the infrastructure tracker pilot program cap remain at the $72.2 million level for 2020, and that annual expenditures continue to be capped at that level without future adjustments for inflation in order to provide reasonable cost containment for the tracker mechanism. This cap does not preclude Dominion from making prudent investments in replacing high-pressure feeder lines if the investment costs are in excess of the cap. It merely restricts the amount of expenditures that are eligible for tracker recovery. An inflation adjustment is not needed because this program consists of a series of unique feeder replacement projects. The Commission should deny the request to add automatic increases to the annual expenditure amount that is eligible for single-issue rate-making treatment, as I believe such mechanisms should be sparingly, if at all. And that concludes my summary.
Thank you, Mr. Higgins. Mr. Higgins is available for cross-examination and commission questioning.
Mr. Meekum, do you have any questions for Mr. Higgins?
I do not. Thank you.
Thank you. Major Kirk?
Yes, sir, just briefly. Good afternoon, Mr. Higgins.
Good afternoon.
In your testimony, you had recommended a ROE of 9.7, is that correct?
That is not correct.
That's not correct?
No. In my testimony, I presented what I called a placeholder ROE of 9.7% and indicated that it was not intended to supplant traditional cost of capital analysis. I did include it, however, as a placeholder because not having some representation of a potential adjustment to return on equity distorts the revenue requirement recommendation. And so for that reason, I felt it was useful to put a placeholder in, which was simply the median ROE that had been approved in the prior 12 months for distribution gas utilities.
And so you didn't perform any analysis in coming to that rate?
It was, as I said, it was based on simply the median of the approved returns on equity for distribution gas utilities over the preceding 12 months. So there was a minimal amount of analysis in determining what the median was, but I did not present it as a specific recommendation, nor did I present it as being, intended to supplant the traditional cost of capital analysis.
Thank you. For the other parties that did do a cost of capital study analysis, have you reviewed their testimony?
Only generally.
Okay. You have no reason to disagree with their conclusions in this case?
I've not offered an opinion on the quality or conclusions of those other witnesses.
Thank you.
Let's see, Mr. Moore or Mr. Snar, any questions?
No questions, thank you.
Mr. Jetter?
I have no questions. Thank you.
Okay, Ms. Clark or Mr. Saban?
We don't have any questions, so let's the celebration begin. There you go.
Okay. Commissioner Clark?
No questions.
Commissioner White?
I have no questions, thank you.
And I don't think I have anything else for you. Thank you for your testimony this afternoon, Mr. Higgins.
Thank you.
Anything further from anyone? Okay, we will then take the Phase 1 issues under advisement. I hope no one is anticipating a Phase 1 order before the Phase 2 hearing. If you are, please get your reasons in writing to us ASAP, because that's not what we're anticipating. But we will see all of you next month at the beginning of the Phase 2 hearing. Thank you, we're adjourned.